This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Good morning, good evening, wherever the hell you are located today. It's May 2022. Put this podcast up for the first time in 2012. Where the heck does time fly to? But it's so much fun. I had a guy on last night, early 80s, Jim Cullen. It's either a $20 billion or a $40 billion fund he still runs. Value guy, very different than trend following, but a super fun conversation coming up on the podcast soon. You know, whenever you can get those old Wall Street pros that have seen it all for like literally 6 decades, there's going to be some morsel, some nugget that you can take away and just say, yes, that was worth my time. And as we continue to navigate 2022 and all the insanity that it is so far, good insanity if you're a trend following trader, bad insanity if you're just a buy and holder and buy and hoper. But against that backdrop, let me give a little best of today. 3 episodes. Martin Luke, trend following trader extraordinaire. I'll let you listen. You will understand the full story. Larry Williams, another trader extraordinaire. You probably know the name. Always fun stuff to chat with Larry. I wish I could talk with him more. And lastly, one of my first interviews, I've not listened for a long time, but I always remember it. It was actually in person at a cafe in Orange County. I want to say Laguna Beach, a Mexican restaurant on PCH. Maybe some of you out there already know what I'm talking about. Beautiful view of the Pacific looking out. This guy's name is Michael Covel. He was the team leader for the MIT Blackjack team, and there was a film made about him and his experiences. Hey, it's blackjack, but it's really trend following. Without any further delay, let's jump right into my conversations today with Martin Luke, Larry Williams, and Mike Aponte. Enjoy. I've had some interesting debates recently. The content of the debate's not so important, but one of the reactions was really interesting. I was ahead on the facts scorecard. The person that was talking with me was not aware of all the facts. And many times when the facts are not on your side, it devolves into an emotional attack. Usually the emotional attack on me. So if I'm just putting the facts out there, it can cause some people to get unnerved. Long story short, this person said to me, well, you know, I don't want to be like you. I don't want to be, you're going to be an angry old man. You're not going to listen to anybody. You're not going to be open to this and open to that. And I thought it was a really interesting comeback. You're going to be an angry old man. You're not going to listen to anyone. You're going to be too set in your ways. This was a person that doesn't listen to my podcast. I am so fortunate to bring on such a diversity of guests. There's almost no way. I mean, yeah, I've got my point of view and all that kind of fun stuff. But in terms of staying young in the mind, I'm so fortunate to bring on this wide swath of people from all around the world with all different expertises and all different types of disciplines. I'm just lucky. It's awesome. Today is another great example of that awesome luckiness that I have. My guest today is Martin Luke. He is the co-founder and director of research at Aspect Capital, a fund based out of London that's always had a certain understanding, a certain flair for, a certain success in trend following trading. For those not aware, Martin was an original founder of AHL, trend following firm that was started in the 1980s, originally purchased by Mann in the 90s, all that work they did at AHL, and one of Martin's original partners at AHL was David Harding, who went on to form Winton Capital. But all that work they did at AHL was taken over by Mann. Mann built it into at one time, which was the largest trend following fund in the world. Fascinating success story to start with these three guys, these three young guys in the early 1980s, finding their way into trend following trading, finding their way into systematic trading. And then to see the branch off, as I mentioned, Martin's now the director of research and the co-founder of Aspect Capital, a very successful firm today. One other note from my perspective, I think back to the turtle story. The turtle story was about two guys that had tremendous success already, and they seeded these new traders, these up-and-comers, and showed them how to do it. But those new traders really didn't have anything. In my mind, AHL is almost that in reverse. So AHL were these young guys with barely anything who ultimately seeded what became three of the largest funds in the world. That's a pretty cool story. I hope you enjoy this conversation with Martin. I was thinking about our call today. I'm thinking of all the assorted conferences that I've been at, and I was just wondering if we crossed paths that we never met or something. Or I don't know. You've done these events though. You've done these things.
I have. We've the one I remember seeing you at. I think there's a picture of it on your website. You had Larry and Ed. Is it Sakota?
You know, that's often debated. Sakota. I'm not sure. I think it's Sakota.
How does he say it?
I think it's Sakota.
Sakota. You had him on stage with some. It wasn't ukulele. He got out his banjo.
Yeah. The Whipsaw song. So you were the audience for that, huh?
I was the audience for that.
That was probably an interesting audience. I probably would have, because when you're on stage for one of those things, you're in your own little world, and you don't realize that that's probably a pretty interesting audience at that moment in time.
Exactly. And it's it's voyeuristic because you guys are having so much fun, and just you could be in a bar, the three of you, and the rest of us are like voyeurs.
I sometimes wonder, is it something that comes with age where you loosen up, or do you think guys like Larry and Ed were always that way?
A bit of both. I obviously I don't know Ed at all, but Larry's always been. So he's always been older than me, and that will never change. Probably he's always been wiser than me. But, and actually I haven't seen him for a while. So whether he still gets wiser or whether he has just sort of plateaued and that wisdom is enough to carry him through, I don't know.
Yeah, I probably have more interviews with just me and Larry in his office on tape that I can't release. They're awesome wisdom, but there's just a lot of color there that I can't put out.
Yeah. I can believe that, Michael. Listen, it's a pleasure finally to get to speak with you. I have your book on my desk and have owned this for many, many years. So thank you for everything you've done for the industry.
Well, thank you. Thanks for the nice words.
I'm surprised we haven't spoken.
Yeah, it's just, it's kind of funny because it took me, and I should share a really quick story with you. The first time that I met one of your old friends, the head of Winton Capital, and I was in his office, and it was in 2005, and we had just met. It was just me and him and his dog. He started pulling up a screen showing me equity curves of assorted, well-known US CTAs, and then superimposing his equity curve, and then just giving me that wry smile of like, did you somehow or another miss me? That was my first kind of inkling of like the London CTA scene, so to speak, was not at the forefront in the US.
Yeah.
And then there's just an exponential explosion of all of you guys that's just out of this world.
It's an interesting story.
I tell you what, why don't you go back in time? I'm curious, the first moment, and I'm really curious your age. And obviously I know some of the backstory for the audience. That people can do some Google searches and stuff, but I'm curious when you first saw in your mind and you said, wow, this quantitative style, this systematic style of trend following trading, coding it, and trading over a diversified basket of markets, when you knew in your heart of hearts this had changed your life, or at least you knew this could make some money?
Wow. Michael, I think the starting place is, and I'm also just conscious of the audience. Michael, David, and I never quite had the luxury, if you call it that, of having a role model. It wasn't as though we looked out at the investment universe and said, I want to be that person, or I want to do that thing. Certainly for Michael and I, because we go back further than our relationship. Michael and I go back further than our relationship with David. We were at boarding school together from age 13, and then we were at Oxford together. After Oxford, Michael went to work for his father, who ran a small physical commodity broking business in London. I went and took my first job at Nomura, trying to sell Japanese equities to European investors. And Michael, I didn't know what an equity was when I started that job, clutching my physics degree. I was just fascinated by the analysis that Michael had started doing, prompted by his father. So Michael's father said, "Here, boy, buy one of those newfangled computers." There was, personal computers were just beginning to reach the shores of the UK in the 1980s. And Michael bought a Hewlett-Packard 9816. His father, handed a book of technical trading methods and said, "See whether there's anything in this." So the point in answering your question, it's really been so gradual, just over time. I left Nomura, joined Mike. This whole time series analysis just lent itself to, the nerdy physicist's approach. We just discovered some things. We tested every model that we could encode from that great book. We distilled them down to some fundamental rule sets. We tried them on a range of markets. And at that time, Michael, the range of markets that we had available to us sitting in the commodity world of London was, what did we have? Cocoa, coffee, sugar, aluminium, copper, silver, something like that. The financial commodities were really in their infancy. So it was only a few years later and largely, once we'd met David, that we started expanding the application of these models to a more diverse set of markets. So, sorry, I have a tendency to long-winded answers. But
I'm fine. I think the audience is fine. People love that depth. People want to know what's going on inside the mind.
Well, and that's what I'm conscious of. I can't, there was no one moment where we said, yes, we have created, the great imitator of, who was around in those days? Richard Dennis, John Henry, the Mint gentleman. But Michael, we didn't know that. As we started doing, we just didn't know there was that U.S. industry.
Mid to late 80s, we're talking right now?
Even early 80s. So I started working with Mike in 1984. He was working for his father, I think, from early 1983. So I think the earliest AHL track record stretches from 1983. We met David, I want to say, in 85 or 86. And there was a bit of a tussle. David was working for Sabre Asset Management and was the understudy to a great chartist, a man named Robin Edwards, who ran a fund, very systematic, but no computers involved. And David he was a Cambridge-trained scientist, and he immediately saw the potential for using computers to encode Robin's chart approach. So the Sabre folks tried to hire Mike and me out of Mike's father's business, and that wasn't going to happen. So in the end, we got David to join us in Mike's father's business. And then at the beginning of 1987, there was a little family tiff, which resulted in the three headstrong boys leaving with one client and setting up AHL.
Now, but at the moment you guys set up AHL, had you made enough money at that moment in time? You felt like I've got a little breathing room, or was it still kind of, we're not really sure what's going to happen yet?
We didn't have a bean, not a bean. In fact, blood is thicker than water. Michael's father gave, as we parted company, and just said, because Michael's dad, had built his business over the years, and it had morphed from that commodity broking firm into a small asset management business based on the models that the three of us were developing. He had a very, in those days, a parochial or patrician's approach to managing money and to the clients. And then there was just a difference of opinion. We said, look, you can't behave that way with your clients' money. You can't take a paternal view of it. You have to be completely transparent. And we set off on our own. But we didn't have a bean, and Michael's father actually lent Michael £20,000 that we spent on computer gear and rent until we had generated enough fees that we could go and rent our own office and pay his father back. So, but gosh, it was a very long time before we had confidence in what we were doing, actually.
What were you, kind of a two-part question, what were you calling the style of trading amongst yourselves that you were executing? What were you calling the style of trading? And number two, talk about some of the early coding and how you went about the early coding. This was not the age where you could walk out and buy a TradeStation or a Mechanica software or something. This was hard coding in the bowels, so to speak.
Two parts to that. What did we call it? I don't know. Yes, it was trend following, and it wasn't long before we woke up to the fact that there was an industry here, because we had friends in the brokerage community. So again, through Michael's father's connections, there was a firm in London back in the 80s called Rudolph Wolf. They were a metal broker, and they had cottoned on to this idea of raising, as you know, Michael, the roots of managed futures was a client would open a managed account and give authorization for the manager, in our case, AHL, to manage that money. So it was brokers like Rudolph Wolf and some of the early physical commodity brokers that helped us and educated us in what the rest of the industry was doing. So we knew pretty quickly that this was trend following, and we started to get exposure to a much broader set of markets. In terms of the modeling and the development, you had in Michael and me in particular real techie wonks. Certainly I would not get a job now as a developer, but back in the day, that's what we loved to do. Those Hewlett-Packard 9816s, actually the operating system was written in Pascal, and we learned Pascal and we built our models in Pascal. And very quickly, we built an environment that allowed you to encode trading ideas quite, much more simply. You didn't need to write them all in Pascal and compile the darn thing and blah, blah, blah. It was effectively an inline simulation language, which got developed in the days of AHL. Once we became part of the Man Group, and it was a well-funded exercise, we had, code writers, developers just working on that interpreted language. So it was a precursor to many of those, TradeStation, and for a while in the period between AHL and Aspect, certainly Mike Adam had a version of that. Actually, it wasn't his, but it was a similar product that he was marketing commercially. So the software development was very much intertwined with the model development, Michael.
I was thinking about some of my questions for you tonight, and I was thinking about the notion of achievement. And everybody, if they're pushing in some way, is achieving, and we're all striving. And so I think it's sometimes hard to reflect, because here I am, I'm really curious about all these little things. And I think from your perspective, you're just kind of saying, hey, we just started doing this, and it starts working, and we just keep at it. We keep our nose to the grindstone, and there's some ups, there's some downs, and next thing you know, 30, 40 years later, boom, boom, boom. We something interesting there. And then for a lot of outsiders, they look back now and they see the very successful firm Aspect today, but they don't really think about the progression, the evolution.
That's so true of so much in life, is that it's very hard to join dots when the dots don't exist.
Yeah.
You can join the dots with hindsight. So, if I was being really glib, there was a while where the three of us, none of us got those fancy jobs in investment banking that all of our slick friends at university got. So there was the period where, as three scientists, just nerding around with the models and the simulations and the back data and some of Michael's father's money. And heavens, this stuff works. The more we got into it, the more animated and the more excited we got. So we'd have various, there were little sound bites for a while. So it was Revenge of the Nerds for a little while. And then it was, investment bank in a box. Because in the early days of AHL, again, this speaks to just not having the sort of confidence in the models that we've built up, all three of us, over 30 years since then. In the early days of AHL, we did a number of different things, not only model development and asset management. I've spoken about the software development. Michael was already keen on commercializing that piece of software. I, meanwhile, spent a fair bit of time using the software to provide consultancy services for financial businesses. What came to light out of that, Michael, was that you could fairly easily model the behavior and the profitability of investment banks. We did a piece of work for a London gilt trading house. We modeled, how many people, what are their risk limits, what kind of investment horizon do they had the front book traders that were making a market, and they had the back book traders that were holding the house book, if you will. And we modeled the behavior of those things, and said, well, roughly, this looks like the profitability of your business. And the folks, the executives, that their jaws dropped. They went wide-eyed because we basically modeled their business. So, that there was we went round telling everyone, you can sack all of your, Goldman, Salomons, just get rid of all of the traders. They're very expensive and they have hangovers. You could build it all on computers. We didn't believe, we believed ourselves, of course, but everyone thought we were completely nuts. By and large, that's what's happened.
I want to jump up to the mid to late 90s in a second, but I have one kind of early type question left. The notion of systematic. So today, an aspect is 100% systematic, right? Strategies are systematized. When did you, I'm guessing that there was probably a moment where, okay, you're doing all this homework, you're in the early stages of this industry, you're seeing the results, but when did you have that aha moment that, like, wow, we should really take the human discretion of the execution of this out, and we should automate this? When was that moment?
I draw attention to two things. The first was just an awareness that your ability to rationalize the available information, if you could do that pretty quickly and get rid of the noise, we'd all be much better traders. So I tell the story of in those early AHL days, Mike and I came up with a game, and it was just a piece of code that would randomly sample one of the markets in our database, and it might invert it and it might multiply it by a random factor. So you couldn't tell what the market was, but it would obviously keep the integrity of the price series, and it would present a chunk of a time series to you and then ask you to buy or sell, and you'd buy or sell, and then it would move forward a day, and then you'd buy or sell and move forward a day, and so on and so forth. And with that kind of rapid fire decision making, actually, we were pretty good discretionary traders. If you blow each of those ticks up into a 24-hour period with news coming at you and fear and greed and, the chaos of normal life, you become a lousy trader. So that was the first inkling that taking the emotion out of it, just reducing it to the raw information has to be a good thing. The second thing, which I think is a theme we might return to, it turns out to be the importance of risk management, because what a lot of people focus on in any model development is the models. Are you going long? Are you going short? How do you feel about this market or that? And that's all well and good. And you obviously need to develop those models and be able to articulate what the underlying drivers are. But I think what many people miss is the risk management component. Where I'm going with this is that what a lot of people do is focus on systematizing the models, and then the portfolio construction and the risk management piece they leave to discretion. Somewhere in the genesis of Aspect, we realized that that's absolutely, that's a crucial thing to get right. You need to be able to systematize not only your models that interpret the price data and determine the confidence you have in that particular trend, but also you need to be able to systematize your portfolio construction process and your risk management process. So the manager that says, I am 95% systematic and 5% discretionary, Michael, is 100% discretionary. That's not necessarily a bad thing. I'm not saying that there aren't many geniuses out there who are discretionary, but it means you can't rely on the scientific process. You can't rely on the quality and the integrity of the simulation and research process if you're always resting on if there's the hint that you're just going to step in and down gear the portfolio when the going gets tough, or you're going to knock out a few markets when they, seem to be a little off the charts, because you can't build that into your simulations and you can't know what you're going to do in the future. So, over the years, although we knew at the outset that it was a good thing to systematize, over the years, I've become more resolute in how important it is across the entire investment process.
It's really interesting. You talk about that notion of 95% systematic and some portion of discretion. That was a very common marketing line in the disclosure documents of trend following CTAs for a long, long time. And it was almost like this mysterious thing, like we're 95% systematic, but there's this magical 5% discretion, which is the reason you're giving us money. And I always used to think about, this doesn't make any sense. Now I think probably because you and other peers, associates, et cetera, have gone the opposite direction and said, hey, hold on. I don't think you could probably get away today saying in the quote trend following space, we're 95% systematic. I think people that want to invest would probably say, explain that.
Yeah. Well, it really depended who you were talking to. And we all lived in fear in the early days of the black box label. So I think there was also an element of, I think two things. I think that 5% discretionary was also to give some investors a sense that there was a thought process, and it wasn't just this, ignorant machine clunking away. But also, I come back to the point that people built the models, and then, for example, the overall risk target of the portfolio was something they would set discretionarily on how it felt that week, day, month, or epoch.
I just think it was a weird point in time where we had not yet got to the point where there was an acceptance of the 100% systematic. So there was this gray area in the marketing, and for good and bad reasons, perhaps, as you're saying.
That's exactly right. And now it needs to be used judiciously. So the idea of being systematic, the idea of being research driven, as an investor, as a, consultant doing your due diligence, you've got to scratch at that, because, as I give a bright young graduate, an infinite amount of data and an infinite amount of processing power, and they're going to come up with the works of Shakespeare, or they're going to come up with models that just look staggering. And you and I know, Michael, that you wouldn't put your money in them. So the difference between 100% systematic models that are based on, curve fitting, back fitting, cloud patterns, data mining versus 100% systematic models that are based on, rigorous hypothesis extraction, testing, and a whole barrage of statistical tests to make sure that you aren't fooling yourself. Big difference.
I have to give a presentation shortly in a country in Asia, a pretty successful capital, and I assume they knew what I was going to talk about. And they wrote me and they said, "Hey, can you bring these particular charts for your presentation and tell us whether or not these charts are in a trend or not in a trend?" I guess where I'm going with that with you is the diversification direction, because it's amazing that people still, those people that ask me that, they want to fixate on their markets. They're excited about their markets, and they're not even thinking about diversification. That's not even on their horizon. They've just got their markets they're happy about, and they want me to tell them something exciting about their markets. They're going to be disappointed, but talk about the idea where that's not how you look at it. You are saying, what are the targets of opportunity? When that opportunity arrives, we're gonna do something with it when it arrives, but we can't force it. And I still think today, even in 2015, it's still not a widely understood concept.
I think that's right, and I've been in exactly those situations where, whether it's the local conference organizer who's asking you to tell them how great their local market is, or it's the drinks party where somebody's saying, "What do you think about gold?" I have no opinion. I don't even know what country I'm in, Michael, and which way up your stock index is. But I know it's in my portfolio, and I know it's one of the 150 plus assets that we monitor 24 hours a day, and that we always have a position in. And depending on how those trends have unfolded, we'll have a larger position, and depending on how those trends have unfolded, we'll have a long position or a short position, and that's the beauty of it. So over time, our style, the way Aspect has developed, and I'm hesitating just because I acknowledge that it's idiosyncratic. Many managers will have a different approach from ours, but I start from the very high level premise that all assets have an equal opportunity to manifest trends. So the whole model building process is an attempt to preserve that opportunity and make it as broad and robust as possible. What do I mean by that? What I mean is that if you build your model such that it captures some of the characteristics of different markets. So you trade hogs subtly differently from how you trade treasury bonds, for example. You can think, you can squint and persuade yourself that you're building in some features of those markets, because clearly the world of hog traders is different than the world of bond traders. But I put it to you, Michael, the dynamics of those markets are, at that level of resolution, there is, in our opinion, no persistency. All you can say about hogs and bonds is that they have the potential to demonstrate trends. If I had looked at, say, equity markets if my data set was, this is somewhat spurious, but say 2000 and U.S. equities, 2002 to 2007, I could conclude that equities don't go down, or not for long. Or if I look at bonds over the last 10 years, bonds don't go down, do they, Michael? Never. So you could build into your model certain biases or certain scenario expectations, and that's what we try and eschew. We try and avoid those built-in biases. I am indifferent as to whether your regional equity market is in a roaring bull trend, which I know is what you want, conference organizers, or whether it's in a terrible, terrible bear trend. I'm agnostic as to whether it's going up or it's down. And I don't look at how different markets have performed historically and say my models are better at trading commodities than they are at trading financials, and therefore I overweight the financials. I try and keep it as completely agnostic directionally and asset allocation wise, so that it can grab hold of any opportunity that presents itself.
Let me see how I can ask this. So you've traveled a lot. You've talked to a lot of different people. You've had a long career on so-called, quote, Wall Street. What percentage, and this is clearly you can't give me an exact percentage, but I'm curious, when you're talking to people and you're meeting people after all these decades of going down this path, what percentage of the educated financial audience do you think really grasps what you do at Aspect?
Fortunately, Michael, many more now.
I think, is this a hedge?
than did for most of my career. I mean, the irony is that 2008 was largely for, I think for the majority of the finance. I mean, this is terrible generalizations and therefore probably not true. But from my small vantage point, 2008 was the aha moment. And before that, marketing what we did could sometimes be a struggle. And you know that. And the whole, the secular growth of our industry from being backwood, real cognoscenti, esoteric stuff. And we have to say we didn't help ourselves, Michael, with the absurd fees that we used to charge back in the 80s. The evolution of that to, making ourselves look respectable and I want to be a hedge fund too, all the way through to, I think 2008 was where, as a result of that period of performance, 2009, the phone started ringing, and the pension funds and the pension fund consultants that wouldn't take our calls up until that point said, explain again how this stuff works. And then they were really receptive. And of course, you can't make it up, because then ironically, of course, in the aftermath of the global financial crisis, you get a period where this stuff isn't as, didn't perform as well as it had done historically, and as well as our expectations would lead us to believe it does, and it can, and it will. So, to answer your question, I think that the vast majority of people now get what we do, but it wasn't until relatively recently that's been the state. That's been the state of the world.
Yeah, because you bring up an interesting point that 2008 was this watershed where people said, "Okay, wow." I put this in one of my books. I don't know, the analyst. I don't think he's an analyst, but author. This kind of guy that talks on the shows on TV, Ben Stein, and he said, if you made money in October of 2008, you were doing something wrong.
Really?
and it strikes you funny because it's like, but I know where he's coming from. I mean, I know from the vantage and his understanding of sort of trading strategies or investment strategies, where he's coming from. And I guess if you only believe that, then I guess that's a fair thing to say, but it's an amazingly, you're really leaving some things out to say that. But I just love that line though. That's great, right? If you made money in October of 2008, you were doing something wrong.
I love that line. That is a great one, Michael. And I think that, none of us in our industry should think, and I think the respectable ones of us don't think that we've ever finished. It's not like you've ever, I've unlocked the secrets of the markets and my model is my model and now I'm off to the beach, because the markets never leave you alone. And B, there's always some new thing that you hadn't thought about. So yeah, in 2008, I think very topical at the moment is the evolution of portfolio construction, the theory and the practice of portfolio construction. You'd gone at the time, a very learned gentleman, Swenson. The Swenson model of diversification was don't just have U.S. equities, have global equities. There you go. Now you're diversified. I'm oversimplifying it, but certainly he has had, and as far as I know, has no interest in quant strategies. And at the time, that was perceived to be a very valid and very useful form of diversification. And in 2008, that's why you get lines like, if you lost money or if you made money in October 2008, you were doing something wrong, because the worldview was so rigid. So I think it's exciting, and it keeps me young, and it keeps my research team young and energized, because there's always some new worldview that you should explore.
One of the things that I think is really interesting, I've had some of the brightest and most accomplished behavioral economists on my podcast, and what I really find amazing in talking to them is that their work seems to be the embodiment of the traders like yourself, your peers, the other associates in the industry. These going down this systematic quant trend strategy path was really, in many ways, capturing what a Daniel Kahneman was winning the Nobel Prize for, what a Vernon Smith was winning the Nobel Prize for. So I find it really interesting. But when I talk to them, it's amazing that there seems to be this disconnect where all these behavioral economists should be waking up to these quant trend strategies and saying, wow, what a wealth of interesting data and evidence for us to sink our teeth into. But there still seems to be a wall where they've not yet kind of like pulled the hood of the car up and looked under there and said, interesting.
I agree, Michael, and vive la différence. I'm very happy that those folks and the folks at Google have not have not woken up to what it's do. But you talk about behavioral economists. One area that has sort of fascinated me and is the building of agent models. So if you can define players in your complex system, who are the hedgers, who are the speculators, who are the counter trend traders, all of that, you'd think you could come up with a bottom up model for the markets, which perhaps, I don't know, is that what behavioral economists are trying to do? In my limited experience, candidly, don't bother. It's a very elegant mathematical model, but it's very unlikely to be able to make you any money. I think the thing about what we do, Michael, is that it's a bit rough and ready. The models are very sophisticated, of course, and the mathematics is complicated, but it's, you almost start from the premise that all markets will at some point display trends, and it's our job in these models to be able to capture those trends efficiently and not lose money in the periods where we're participating in those markets and they are not trending. There you go. I've just defined what it is we do, but you'll notice that I haven't dwelt on, and it's my job to tell you why those trends exist, where they come from and where they're going. And so I think if you fixate too much on that, which is the role of the behavioral economist, you very fascinating field, but it's not what we do.
Yeah, when I look at what they do, I just see, okay, they seem to do a great job of really putting aside the efficient market hypothesis and offering that, hey, human beings are not always so rational. Bubbles exist. And so if I just look at that very basic premise, their work gets more complicated than that, but that very basic premise, it kind of dovetails right into your world in the sense that it's kind of a foundational explanation for why you might be successful.
Yes. Yeah, and I think it is, and it makes for great reading, and often there are aha moments as you say, yeah, well that's why we sophisticated monkeys behave the way we do, and long may it continue, Michael.
Let me ask you kind of, as we kind of wind down, let me ask one kind of a current big picture issue for aspects. So I'm calling you from Southeast Asia today. The world is a very interconnected place. Everybody's coming online. I mean, if a country doesn't have a liquid futures market yet, they're surely thinking about it. They would surely like one. So we can all. How do you go about this process of bringing new potential opportunities, new potential trading opportunities into Aspect? Talk about I imagine you always stay excited because you're like, hey, we don't even know the next grouping of markets from the next country that's going to come online that can possibly offer us opportunity. I think what's so great about trend following, and in many ways, it is the Indiana Jones of trading in the sense that once you have your models and your systems and stuff, and you know that these markets in these countries are liquid and viable, you can go in.
Yeah. It's an ongoing process, and it's something we devote a fair bit of time and a fair bit of money to, because you've got to keep your heads up. As you know, Michael, it's relatively easy to get started with the 50 most liquid markets out there in the world. And if you just ignore all of the new stuff that you're referring to, you miss a huge opportunity set. As a business, we have a regular cycle of reviewing, news alerts, and our brokers keep us prompted of what's new, what's coming. We like to have some back data, so we're not going to be market participants on day one of an exchange opening, because we've got to get the sort of characteristic heartbeat of liquidity patterns within that market before we can parameterize our execution algorithms. So we've got to establish a little bit of history, and then we've got to establish a threshold of viability, a threshold of liquidity, because it's got to be worthwhile. At a certain point, having a 1 basis point allocation to a market where it isn't viable in the program. So there's a liquidity threshold. I think there's something like 6,000. Is that right? 6,000 futures markets. Globally, you can very quickly cut off 80% of those on liquidity basis as being viable for what we do. And then it's an evolving cycle. As liquidity picks up, we will adapt our allocation in the portfolio. So, and the other feature, of course, Michael, is that there may be constraints. So, for example, we can't currently trade the Chinese futures markets for our investors because external investors are not allowed to participate in those markets. Similarly, access to Brazilian futures markets, which are vastly liquid. There's a taxation situation that makes them extremely difficult and expensive to trade. So all of those markets we're tracking, we're collecting data, we are simulating the models on them, and we're ready to go at the drop of a hat should the legislation change. And we welcome that. We love the additional diversification that it affords the portfolio, because back to the starting point, if you just traded the same liquid 50 markets that maybe we started with in the 1980s, if that was your portfolio now and all other things were equal, you'd have less diversification in the portfolio, because there's a long-term, a secular trend towards markets becoming more homogeneous over time, I believe. So we are hungry for new axes and new opportunities of diversification.
Why do you think you're so passionate?
I'm a one-trick pony. This is what I've done in my career, Michael. I am, by nature, I can't claim to be a scientist or a physicist, but that's what I studied. And I think I got into that because I'm inquisitive and I like precision, and I like answers, and I like engineering solutions to things. So I know myself that I would be that I am a lousy discretionary trader. I like the application of sophisticated mathematical techniques and theories to extract signal from noise. And I love working with a bunch of really, really smart talented people. All of that keeps you passionate to keep learning and to keep competitive and to keep doing what we're doing better and better.
I mean, even if the economics of this was much less, I mean, let's say it was good enough to earn a living. I get the feeling talking to you that this still would have been your passion and your path.
Absolutely. This is just great fun. I didn't set out on day one to be a great trader at all. As I said, I got into this working for Michael's father because I was fascinated by the application of computers to time series data. That's what I've done my whole career. It doesn't really matter that the rewards have been very good. That's a nice feedback loop, actually. Markets are a very, swift judge of how precise and how honest you have been. So
it's how to keep score.
It's how to keep score. Exactly. And that means that I'm not in an amorphous world of where people could say, wow, what a great article you've written. There's a scorekeeper.
Yeah. Martin, listen, it was fun chatting. Hopefully we can talk again in the future. Everybody can go to Aspect Capital and easily find more information on your firm. Appreciate it. Great stuff. Where are you today? You're in America today.
Yes, I am, just outside of Boston. I'll be in London tomorrow and in Southeast Asia next week. I'm sure I will be hot on your heels and, in the aura of Michael.
Oh, you're too kind. Hey, Martin, listen, I appreciate it. Thank you very much.
Nice talking to you. We'll do it again soon.
Today on the show, I have Larry Williams. Larry is a trader and Larry is an author. Larry has been in the trading game for a long time, over 4 decades. His name is very well known in almost all trading circles. I hope you enjoy this conversation. Hey, Larry. How are you?
Pretty good. You're in Singapore? Where are you?
I'm in Saigon today.
In Saigon? Oh, my gosh. One place I've never been. I always wanted to go there.
Where are you right
Virgin
now?
Islands. Virgin Islands.
You sound FM radio good, considering we're probably about 8,000 miles away.
It's amazing, isn't it?
It really is. It really is. Hey, listen, I want to jump right in because as I was preparing for this interview, I do all my Larry Williams homework, searches, and all this kind of stuff. And the headlines that dominate in the last at least couple years are really about the title of your most recent book. I wonder if you might address that, because what's interesting about those headlines, these IRS headlines that you faced, is that it's really the beginning of the story and the headlines don't reflect the end of the story.
Yeah, that's true, isn't it?
And I think the really interesting thing, and I'll let you expand on this too, is that, and I've not had a chance to read this book, and you can expand on it as much as you want. I think I'm going to go read it for sure. But the idea that when you had gone through this whole process, you ultimately said, and I'm paraphrasing, I can only put so much blame at the feet of the IRS. It's really about Congress. Is that a paraphrase or is that close?
Since the book has come out, what we now know is the IRS has targeted specific peoples and groups. And I was indicted, and we'd been in touch with the IRS for years trying to work everything out. I was indicted the week that my daughter was up for an Academy Award, the Academy Awards week. And I was a great poster child within the industry, the facts that I was in Australia and she and Heath Ledger were a couple. And I had been in the United States before. Why was I indicted in Australia? I could never figure that out. But now, when retrospect and knowing that the IRS has been a rogue agency for a long time period, some pieces of the puzzle fit together better now. So do they target people? Sure. Was I high visibility with an industry? Yeah. Is it an industry they want to scare? Yes. So I was a great target. I was a poster child. So so whose responsibility? And ultimately, we should have a different tax system, and that's Congress's position. The IRS just enforces. But the way the IRS enforces things leaves one to question their reality.
You raise a great point, and I think everybody in the audience knows that there has been targeting, and I think it's a matter of public record. You raise a really good point.
Yeah, and clearly in my case, I followed the advice of some lawyers and CPAs who were pushing the edge of the envelope, but they were Price Waterhouse guys and, lawyers, and they said, do this and you'll be okay. And I did that. And assuming for a moment the IRS was correct in their view and I was wrong, there's no mens rea. I was doing what professionals told me to do to minimize my tax obligation. But the IRS would never listen to that viewpoint in negotiations prior to going to trial. Never, ever, ever. It was only, do you want 6 years in prison or do you want 3 years in prison? What type of deal do you want to cut? And I said, I'm not going to cut a deal. I'll go down swinging one way or the other. And eventually, of course, when all the charges were dropped, every single charge was dropped, they finally had a realization in trial that they couldn't win the case. And so on the third day of trial, they said we could see him texting back and forth to Washington, D.C. It was actually kind of funny. And then they wanted to recess, and they made an offer, and we talked and came back with it, and eventually said, okay, this is what we'll do. But yeah, their unwillingness to negotiate with me, well, they were with other people, I think just reinforces the targeting aspect.
Yeah. I mentioned to you an email, and I've not talked about this in my podcast, but I had a case in Virginia that went on for nearly 5 years. And in hindsight, it's very difficult when you really know you're doing the right thing, you really know the government is overreaching. And so I relate to the idea, and I'm sure many people, unless they've gone down this path to standing up to the government, you can't really truly imagine what it feels like to take a, quote, good fight forward, or to try and do the right thing, or to have not done anything wrong, and then to be on the other side of a behemoth that has unlimited spending power. Even at the local government level, they can hire whatever attorneys they want, and they pay whatever bills they want. It's amazing.
Yeah, somebody estimated they spent about $6 million on it. We spent maybe $2 million in my defense. And I've taken one case all the way to the Supreme Court of the United States, which we won. We took one all the way to the Supreme Court of Australia. We won at the High Court and lost on a split decision at their Supreme Court. People don't realize, I think, two things: enormous cost, and as you pointed out, the time. These things go on and on and on, and it just drags on your psyche. They just don't sense that, and the government will send out all sorts of news releases. We've indicted so-and-so, what a bad guy is. But after all charges were dropped, the government has yet to do a news announcement saying that we dropped all the charges. They refuse to do it.
Right there is the most telling example, and I'm not putting words in your mouth, but to me, it's the most telling example that it is personal. Because if it's the government and it's objective, if they want to announce the charges, then they should be willing to do the exact opposite when they're wrong. And when they don't, it tells you it's personal. And when the government's personal, that's scary to me.
Yeah, it is. We tried to not make it personal against the fellow who was prosecuting us, but either he had directions or he did take it personally. I don't know, but it's you can get destroyed in the media, and then everyone forgets about it. And so that's the story. But when you're victorious, that story never comes out. And that's really the responsibility of good journalists.
Well, the book is called Confessions of a Radical Tax Protester. So for those folks that want to check it out, and for those folks that are tuning in and expecting us to jump right into trading, I frankly, like I said, doing my research here today, I wanted to make sure I kind of discussed this right out of the gate, because it did make a lot of headlines. And I did notice that your daughter's name got tossed into it. And that's kind of, it's unsavory, right?
Yeah, but it's what is.
Yeah, it is. It is.
This is America. This is what they do. You have to learn that's how the game is played.
Yeah.
And you have to have a strategy to deal with that, an emotional strategy as well as a legal strategy.
Yeah, well, you seem pretty calm, cool, and collective about it. I might have had more of a meltdown.
Well, I think years of trading helped.
So listen, let me jump in, and I want to go back to your very beginnings, because I announced to my Facebook that I was going to be speaking with you. And it is interesting. Your name, you have so many people that when they hear your name, they are just interested. They want to hear what you have to say, and they get excited. And I'm still a novice to some degree. I'm a newbie when it comes to Larry Williams. But I want to jump in and let you go back to the very beginning. And I've seen you give some comments about this before, but I want to let you discuss how you even decided to approach trading and what were your motivations?
Well, it began in 1962. I was looking at a newspaper and I saw that a stock was up 0.1 or plus one. Had no idea what that meant. I come from a working class family. We never owned stocks. And so I said to a friend of mine, what does that mean? He said, well, if you would have bought that stock yesterday and got out today, it would have made $100. And back in 1962, that's probably like $3,000 today. And I go, wow, this is for me. You can just guess and something goes up and make money. This really attracted me. So it was just pure. I'd seen my dad work real hard in an oil refinery all his life. And he always said, learn to work with your head, not your back, like in his hands, like he has. And I thought, wow, this is interesting. You just make money looking at a newspaper. And of course, I thought it would be easy. And of course, I've come to find that that's not correct at all. But that was just pure greed, what first interested me in it.
Let me take even a step back further. You grew up in Montana, right?
That's correct.
So I've not had a chance to visit Montana, but and I think people hear Big Sky and they know it's a massive state. How did growing up in a state like Montana, which is a state of resourcefulness, a state where you probably have to take care of yourself a tad bit more than growing up in a big city. There's a lot more that you have to be aware of and take care of. It's the life in being I don't want to say the country, but just a more rural growing up. How did growing up in Montana affect you personally?
Well, I think first of all, that's probably the most insightful question I've been asked in any interview. I've never been asked that before, but I have cogitated on a bit. And I think two things. First of all, as I see kids growing up in a big city, it's hard to be really creative because your mind doesn't just flow in the mountains and the streams and hiking. And I think you can get much more creative growing up because you learn to create stuff in the environment and see it change. So I think that's been very helpful to me. And the other thing is that everybody in Montana is hardworking people, at least it was back then. And you really treasure money and hard work and a work ethic that says, I used to ride rodeo and you're going to get bucked off and it's going to hurt, but still you get on and hopefully you can hang on and you're going to win. It's kind of like in the markets, really. You're going to get bucked off, but if you stay on, you win some money. And you pay to ride rodeo. And you get bucked off, you don't get anything. And it's kind of like the market as well. So I think there was that general idea of entrepreneurship, though my father worked for a large oil refinery all his life. My grandfather had a grocery store, and maybe I got the entrepreneurship from him. But just the idea in Montana, it not only is a big sky country or the treasure state, but it's big thinking country. You just, it's amazing the people that have come from Montana, the things they've done, in part because I think they have that very open mind about, hey, I can do whatever I want to do.
Well, and you've done that. I mean, back in the 1970s, I believe you were the Republican nominee for Senate on, was it 2 elections?
2 elections. I lost to Senator Baucus, who went on to be head of the Finance Committee, and Senator Melcher. And unfortunately, I chose to run against incumbents, which is really a tough position, but occasionally they get knocked off. It was a great opportunity to.
I know I'm bouncing around here a little bit, but you've got such a varied background, so you have to excuse me. Look, here we start the podcast talking about this most recent issue that you had this battle going on, but politics is the ultimate battle in the government. So here you are running. How did you decide to put your name in the hat ultimately? I mean, what were you thinking to yourself and say, I'm going to run for Senate? What was going on in your head? What did you want to get across to the people? What did you think you could do better than the guys that were out there?
Well, in terms of the Republican primary, I actually called the chosen guy who was running for the Senate, and I said, "Hey, Bill, I'd like to know where you are in your positions on a couple of issues. Maybe I could help you." He said, "Well, I have a committee that will tell me my positions on the issues," and that just turned my stomach. I thought, "What? You don't know your own positions?" That kind of was a triggering agent. And then, be really honest, one night my buddy and I were driving in Montana back from someplace, and we stopped and had a couple of beers. And about 5 beers later, he figured out that I should run for the U.S. Senate, and I was too dumb to disagree with him. It was really all about less government. It's the same issues today. Nothing's changed. We should probably have balanced budgets. We should probably have less government. We talk about that we may run out of money for Social Security, but we never talk about running out of money for welfare checks. But like this whole system's out of balance. I had seen too much government interactions with the SEC and CFTC and in my business. So I figured, hey, you know what? Montana's got some problems. I understand futures, future price, wheat, cattle, oats. So I felt that I could represent the average voter better than the other guy. And that's what got me in the office running.
So a quick story about me. When I was 21 years of age, I was living about 15 miles outside Washington, D.C. in a small town in Virginia. Today, one of the wealthiest counties in the country based on the numbers of federal employees living there. But when I was 21, I actually ran for mayor of the community I live in against a guy who was 72. And I have to tell you, putting myself in the spotlight at such a young age to be involved in politics, and it was a serious type thing, that changes you. You either continue with it or you say, you know what, I've had enough. I'm going to go do something else with my life. And I said I had enough.
Yeah, I can certainly relate with that. I think there's a point where if you're heavily involved in the political process, I was regional director for John Connolly's presidential campaign, worked on Ronald Reagan's campaign and Jack Kemp's. I mean, he did a lot of Iowa primaries and stuff. And after a while, you kind of say, you know what, enough. It's like in boxing, protect yourself at all times. I got to protect myself, get out of the ring here, make certain these guys, don't continue to screw up my life. And that's one reason why I'm in the Virgin Islands. It's great tax structure here, a lot of freedom here. We're part of America, but yet it's different than America.
Yeah. Well, let's jump back into trading. This is what most people want to hear. They want to hear your insights. And I want to go back to some of the beginnings and maybe let you elaborate on a word that I love. And it's often a word that is, how do I say this nicely, bastardized in common parlance, but the word speculate. To speculate is an awesome endeavor, in my humble opinion. How do you feel about it?
Well, yeah, and if we go back to the Latin root for the word is specular, which is to see, like glasses, spectacles, right? And the difference between a speculator and a gambler is we observe things and make certain references and then determine what the future should be. So we're not gamblers. We're actually making observations, and based on those observations, we're correct or we're not correct. And it's interesting. The other day, somebody was saying, "Oh, you speculators drive up energy prices," and they're all upset about speculators. Okay, I don't think they do. But if they do, what about when energy prices collapsed a couple of years ago? Do speculators get credit for that?
Hey, don't ask the obvious question. Don't ask the obvious question.
Yeah, they only look at it one way, and they don't really realize that if we didn't have speculators, the markets would be much wilder than they are.
Yeah. So why don't you continue on this thinking? So you're in Montana, you're a young man, you're wrapping your idea around trading, you're seeing starting in stocks. How did you make the migration to thinking about commodity futures? I mean, I naturally, I think, and I've talked to Salem Abraham, who's a trader out of Texas, about this, growing up around cattle and whatnot. I think it's a little bit different than kids that might grow up in the city. You actually see and understand some of the mechanisms for the buying and selling of animals at a young age.
Well, I understood math. A broker told me that I could get, without having to pay interest on a margin account, I could control $30,000 of pork bellies for $500, or I could buy $500 of stock. Where do I get my biggest bang for my buck? And once I had that realization, I thought, well, futures is a lot more attractive in terms of what your potential is on the upside, and of course, on the downside as well. But that was the really switch point, was just the economics of it, that I got a much better deal, and that there's real demand and supply for corn and wheat and gold, and there is no real supply or demand for IBM or Apple or Google. I mean, you really don't need a share of Google. You can live the rest of your life without it, but you can't live the rest of your life without wheat and sugar and coffee and corn and gold and silver and all these things. So we have real data about those markets, real fundamental data that we don't have in the stock market. There's no true demand for them.
How did you start to put the pieces together, though? Because for the average trader, for the new trader, even for the established trader that's out there, there's a lot of different factors going on. So you have the emotions of it all. People just getting excited. They flip on CNBC and there's 6 suits jumping up and down, and you start jumping up and down, and you call your broker. But then there's the issue that you brought up with the leverage inherent in commodity futures. If you don't have risk management, if you don't have a money management strategy, you can end up in a bad place fairly quickly. So how did you start to put the pieces together about the emotional part of it, the money management part of it. I'll let you continue there.
Well, I guess I was lucky. There was no CNBC when I started. So you didn't have all those things pulling at you. I really just got into the first book I read was Joe Granville's book. And later on, Joe, who unfortunately passed away a month ago, became a friend of mine, both he and Karen. His book was very inspirational about, there was logic to this business called stock trading, but it was all technical. And I traded as a technical only guy for probably almost the first 10 years. And then I met a guy, Bill Meehan, who had been a member of the Board of Trade, who was really into the fundamental aspect and taught me the fundamental aspects of markets. And we came together, two guys, Keith and Kevin Campbell, who run one of the largest funds now in the world, out of Baltimore, had been a friend of Bill. And it's really interesting. Bill was the inspiration for a lot of guys. And what I got from Bill was that markets get set up for big trend moves. Technical stuff will call all the trends, but you get whipsawed to death. So what you want to do is put a trend mechanism on top of a fundamental conditional setup market. Then trend isn't just hoping that one of these things goes up. You, as a speculator, you're observing that this time, this trend change should be better than just a 20-day average crossing a 10-day average or whatever. So that was the total perspective Bill gave me, the conditions set up markets for trend moves. And his problem, why he came to me, why we worked together, he had no clue about technical stuff, timing. Technicals are all about timing, but you don't know if it's going to be a massive move. You don't know the magnitude of the move. Just because you get above a 50-day high, it doesn't mean you won't go right back down. But if the fundamental conditions are there, then the trend change is much more sustainable.
I have to admit fully, and I think you probably know this about me, I am not a fundamental guy, and I can't add any value there. I can appreciate that there are definitely people on this planet, and I think you've had some experience there for sure, who have been able to pull it together. I know Ray Dalio, and I sometimes want to know what his secret sauce is, but Ray Dalio swears, I don't know if he swears, but he says that he trades only using fundamentals, but trades them systematically, which was intriguing to me.
Well, when we were roommates together many years ago in New York City, I think he scoffed a little bit at my technical stuff, and I scoffed a little bit at his fundamental. It wasn't until years later, that I haven't even seen Ray since somewhere in the 70s, that it was really interesting. We both pop up again with a little different trading style, but clearly I think fundamentals are the basis for the magnitude of moves. And I know students of mine who now manage money have taken my work. This is exactly what they've done, what we've always talked about. They'll take a turtle channel breakout, but only if there's a conditional entry there. And of course, then you don't have to wait for, say, a 20-day high or a 50-day high, because if the conditions are there and they're ripe for a significant move to the upside, then you can buy at a shorter time period high or moving average or whatever your technique is, because the stage is set for a big up or a big down move based on the fundamental conditions of the marketplace. I don't disagree with trend following. I think it just has to be used selective. I don't disagree with using a hammer, except you got to find the right place to use a hammer.
Yeah, there are different approaches. I think sometimes what I do, and people get into debates with me, I've enjoyed being in the trend following world because there was so much data to observe. As a young man coming into it, I could see all this data and observe it. On the flip side, if I picked up Seth Klarman's Margin of Safety as a young man with a political science background in my early 20s, that was a much more difficult proposition for me to wrap my arms around.
Well, margin of safety, I think that's one of the incredible learning experiences that I went through, and that maybe every trader eventually has to face. And that is the risk control aspect of this. It doesn't matter if you've got the greatest system in the world. If you don't learn how to control and bet size and manage your account, you really have to manage the markets, your trades, you have to manage your equity, and you have to manage your emotions. You've got to really touch on those three legs if you're going to be a successful trader.
Well, I brought those up a second ago. So why don't I let you expand on the phrase money management? Because even though people have heard it, it's not something that resonates with a large segment of the population. Many people, you could take a doctor, an attorney, a young man out of college. It's a subject that's still, you've been at this for a long time. It's a subject that's still in the weeds. It's still hidden away. The idea of money management, bet sizing, position sizing, however one wants to call it.
Well, I'll make it real exciting here. I took the $10,000 to $1.1 million in a real-time trading championship because of money management. My daughter, when she was 16, took $10,000 to $110,000 real dollars in a trading championship. And a lot of my students have done this similar thing or comparable. Nobody's got our records yet, but they're trying, and they do really well. And it is, sure, they're decent traders, maybe even good traders, great traders, but it's the money management that gets the exponential growth of the account. But that sort of has two sides to it. And really, to simplify it, it's that trend is the basis of all profits. No trend, you're not going to make a nickel. But trend is a function of time. So the time you're in the trade, it gives you more opportunity for trend, which is why day traders have the deck stacked against them. Time runs out at the end of every day. They cannot catch a big move. So they have to bet large to make a lot of money. My game is to bet small. And if I lose, then I can only lose small. Whereas if I catch a trend move, I can catch a substantial profit because I have time in my favor. So your time frame is part of your risk management. And the overall underwriting rule is really bet small to win big. You have to bet a correct amount based on your system. But even at that, as I mentioned earlier, if your emotions don't allow you to handle a $50,000 loss and you're trading $1 million account, whatever, if your emotions don't let you handle that, you can't make that size of a bet. It isn't just the math of it. You've got to actually have an emotional quotient on what risk you can emotionally handle, and then strive to find where that optimal F is that Ralph Vince has written about.
Yeah, Ralph was on the show. Ralph is a really interesting guy. I'd love to meet him in person. He was awesome.
He's the smartest guy I've ever met. I've met a lot of brilliant people. I don't know if you're aware of, you've probably read Ralph's books. Ralph never took a class in math.
Yeah, it's amazing.
That's all self-learned. He's amazing and just a great guy. Just had a lot of good times together.
Let me keep going on the money management though, because I think let's phrase it this way. I've done this before at an event, you tell people, you say, listen, okay, you got $100,000. How much are you going to bet on each trade? And I've asked a room of 100 people this before. And it's amazing, the numbers. I mean, you've got people that raise their hand and say, I'm going to bet $10,000 on each trade. They only got $100,000. They're going to bet $10,000 on each trade.
Well, if your emotion can handle it, and I would precede it with that, the maximum bet that I would make would be a 4% risk or $4,000 potential risk in the trade. I think that is the optimal number, all things considered, for most all traders. Probably a 2% is more manageable. And people think, well, I can never make much money with a 2% risk. A couple of years ago, when we were in Australia, I started a $100,000 account. A year later, it's a little over $1 million. And it was on 2% risk bets. Probably most were 1% risk bets. So you don't have to bet big to win big if you're catching large moves in the marketplace. I think optimally, and I can show mathematically why, 4% is about as heavy of a bet as you want to make. Or as a risk, not a bet, but a risk. That's how much, if I'm wrong, I'm going to lose 4% of my account.
And you would consider 4% on the heavy side.
Pardon?
You would consider 4% to the heaviest end that you would go.
Yeah, to the heavy side. And here's why. It's not uncommon for me to have 3 or 4 losing trades in a row. So if I have 4 losing trades in a row at 4%, I'm down about 16, 20% of my money with slippage and whatever. And so that's frequently happens in everybody's systems or everybody's trading approaches. So I have to be willing to have an equity drawdown I can live through, not sit through, but actually live emotionally through that. And a 4% risk that's pretty gutsy.
Why don't you talk about the emotions? Because you just said it, living emotionally through it. You know, somebody's listening and maybe they think they know what you're saying, but do they really know what you're saying? Is it, it's the waking up in the morning? Is it you're thinking about it too much? And I'm not saying you, I'm just saying the wrong way to do it. That you're thinking about it during the day. Talk about that, the emotions of it all.
Well, I have a lot of experience in doing the wrong things in the markets, so I'm real qualified to speak on this one. The other things I don't know, but I've done a lot of wrong things in the markets. And I think the underlying thing is the human brain is wired to be right at all costs. So we get into arguments because we want to prove we're right. People kill people on freeways because somebody cut in front of them. We'll be dead right, literally. we just have to be right. And in the markets, you can't be all right all the times. And you have to learn to accept that. And if you can't accept that, you get really frustrated and very angry about the markets and that you're losing, you're not making money. The guy next door, your brother-in-law, is making more money. And it's just, it isn't just the size of the loss. It's the fact that you're losing, and maybe 2, 3, 4 times in a row you lose. And that makes you think you're a loser. And you get in all sorts of emotional traps. I don't know if you're aware, my son's a psychiatrist trained at Johns Hopkins and did an interview with 20 major traders, big-time traders, names you know. And the takeaway from his in-depth personality profiles of all these people is, he's the first person to just interview successful traders. None of these successful traders have really big egos. They're not overly confident people. And that was one of the most important takeaways to me, is that we have this impression that traders are gunslingers and they're totally confident, and those are the losing traders. The winning traders don't have a great deal of inner confidence, and that's why they control risk so much better than guys who think that, you know, the God's gift to the markets.
I feel very fortunate to have sat down, talked with, become friends with, shared experiences with some men that have so much market success that their kids, maybe 500 years from now will still be living off the residual. And you're right. Most every one of those people that I've had a chance to be around, names that people would know, they put their pants on exactly the same way. And they just act down to earth. They've had a system, they've had an approach. Maybe there's been a little luck on their side, but they've grinded it out, and they've been at the right place at the right time, and things have taken off. But I find they're just down to earth, very down to earth.
Yeah, you look at a guy like Steve Cohen, who's just, you know, you wouldn't have any idea this is a billionaire, you know, 4 or 5 billionaire type guy, done 30% a year for 30 years in the marketplace, and he doesn't have that persona that the movies have made out, or somebody like Paul Tudor Jones, Ray Dalio. And these guys are pretty much salt of the earth people, and understanding that, I think, helps us to become better traders, to see what the personality profile of winning traders is. Another interesting thing that Jason's book pointed out, his research showed, is that all of these really successful traders found a strategy that fit them. So some are fundamental, some are technical, some don't want a system. Some, if you gave a system to, they could never follow it. But they're really good traders on their own, using their own discretionary ideas in the marketplace. And they had to come to that notion. Some went from going to systems to discretionary. Some went from discretionary, realizing that they had to be a system trader. Your personality dictates largely the approach that you should be using in the marketplace. And too often people say, oh, Larry Williams, I'll just follow his stuff, or I'll just get the turtle trading system, or whatever, not realizing, does that fit you? You really have to answer that question.
And that's a good question, too. What is the definition of fit? And I think that not as much research as your son, perhaps, but some of my casual observations is that most of these men they said, well, is this a good opportunity? What's the science behind it? Let's stick with it. Let's execute it. Let's run it like a business. Let's have a profit center. Let's run it like a business. And I think that seems to be a common thread that I've seen in so many of the traders that I've had a chance to sit down with, learn, and interview from.
Well, and I think the ones that you've interviewed, which are legendary traders, they are different than guys like me. They are so much smarter because they're not only great traders, but they put together business enterprises. I'm basically a writer. I have my degree in journalism that turned trader. And these guys are business guys that have put together organizations of thousands of employees underneath them, managing billions of dollars. So not only are they great traders, they are brilliant, absolutely brilliant business people. And there's a real difference between just the trader and somebody who can make a business out of the art of trading. I mean, I have so much respect for these people. They are just so far ahead of most of us in terms of just the intellectual qualities of their life. Oh, my gosh. Amazing.
Taking on the responsibility of losing money for other people is not easy.
not fun.
No, that's not fun at all. Hey, listen, let me shift gears on you a little bit more too. So the idea of markets changing or the conditions in markets changing, I think many times people, maybe new traders, they approach the markets and they get caught up on this word change. So let me ask you, big picture wise, how much has really changed about the condition of markets since you got started to today?
A lot has changed, but it's technical change. It's change in how long it takes news to get disseminated. I'd get the Wall Street Journal 3 days late. The content and the delivery time period of news took much longer. Now it's instantaneous. So that's one thing to deal with. But the big change really is, we've gone to electronic markets. I made fortunes off the opening gap from the day close to the next day's open. And because we had a time period of, 10 hours, 12 hours where nothing was happening, well, we don't have that gap anymore. So I had to seriously alter a lot of my trading styles because I didn't have that opportunity to take advantage of anymore. So that's a huge, huge change in terms of my trading. But I still think supply and demand drives the markets, and the technical emotions are really technical, I think, measures emotions. The wiggles and waves as we go from point A to point B are technical. The overall trend from A to B is fundamental. And those emotions are still the same. As you know, we can go in any country in the world and look at their markets, and they just look like the markets here, except maybe China because you can't sell short. But the same patterns are there that we see in our markets. So these aren't chart patterns. These are patterns of emotion. And we're all humans. We all have fear, greed. Doesn't matter what your culture is. So that stays the same. How we trade markets, we're all electronic. There's a lot more traders now, so they're a little more emotional. That's a change, but not the core fundamentals. Those haven't changed.
Let me shift gears on you again. Since you've seen everything, so I'm just going to keep asking questions. So in the last couple of years, and I had a hedge fund buddy of mine call me recently, and he was having a conversation with a fund manager friend of his, and they were talking about volumes in Chicago, and they were talking about MF Global, and they were talking about a VIX, at least until the last month or so, has been non-existent. And they were also talking about London, and they were talking about funds, big U.S. funds moving offshore, and Dodd-Frank and QE. So is there something structurally going on that maybe has kind of come out of the two-headed monster of MF Global and current QE policy that is possibly changing the structure or the trust in the markets, the commodity markets that you've known since you're a young man?
Yeah, the trust is, I think, the big thing. The EDF Man fiasco, and then Russ Wassendorf, that's another great fiasco where the regulatory people won't take responsibility for not regulating who they should have. A lot of people are going, the commodities are as risky as I was told they were. And so I think we've dried up some of that. There's been some shrinkage, but there's been this whole expansion of the Forex or FX market. And that actually concerns me a great deal because so many Forex people are saying you can open an account with a credit card. You only need $200 to trade, and we'll give you 100-to-1 margin. I have more respect for people selling crack cocaine on a street corner than somebody's going to give you 100-to-1 margin. And it's ridiculous. 100-to-1 margin, you're going to lose all your money at some point. It's just a question of time, this day or tomorrow.
And so we have IRS agents chasing you down, but the 100-to-1 FX margin guys, as long as I can remember, have been promoting that as a legitimate investing type opportunity, and the regulators just stare in other directions, I guess.
Yeah, well, and I think they changed it now. You can only offer 50-to-1 or something like that, but it's all ridiculous. Like, oh my gosh, and your commission is higher there than it is in the Globex or the ICE. So, but it's all a promotional thing, and I guess that's another thing that never changes. You always have these guys out there. You always have humans are greedy and want to make a lot of money, and you have guys who will pander to that, whether it's internet marketing or whether it's Forex or commodity trading or stock investing. There's always somebody there to indicate maybe you can make money quickly. You can raise red worms in your backyard and sell them to fishermen. There's always somebody with a deal for you.
Indicators, something that is near and dear to you, and many indicators with your name affixed to them. I think a lot of people starting out in the markets when they first learn of technical analysis or trend type trading. They see these indicators, they get excited, and once they get what it is, and then the next thing you know, you've got a chart that looks like hieroglyphics on there. There's so many things going on that it's just destined to not work, but they don't necessarily see that. Why don't you talk about the idea of KISS, keeping it simple, stupid, so to speak?
Well, I think it's really important that because all these indicators are really redundant. For the most part, if you look at the Bollinger Bands percentage or Williams percent R or RSI or stochastic, they all look almost exactly the same. I've done presentations on this. There's not an ounce of bit of difference worth between them. Yet guys will have all these indicators or gals on their screens, and they're just redundant. And they are actually redundant of price because they're based on price. You know, when I took logic in college, my professor, Albert Castell, said you cannot predict A with A. You have to use B, C, or D to predict A, but we're using price to predict price. And there are some aspects of price maybe we can look at that are helpful, but there's so many indicators that you don't know what to say. So I think you need to break down your indicators into a couple categories: the fundamental ones, the emotional ones, and the trend ones. And then whittle those down to as few of those as possible. Then you have a sensible approach. I only, on my charts, I have 3-4 indicators on my charts. That's it.
Yeah, I think for some new traders starting out, that might seem foreign, but I think it's good for them to hear simplicity.
Well, there's no perfect indicator. I mean, I've got some really great indicators, and they don't work a lot of the times.
Yeah,
they work often enough, but you just because somebody, as you know, people will show indicators in books, and in an uptrending market, all this stuff works, but markets don't always trend, and they never show in the books the bad aspects of this stuff. So everything looks perfect. And then you start trading it and you run into reality that actually a divergence in an oscillator may be very bullish, but the books say it's very bearish. So you got to be so careful. As Ronald Reagan said, trust but verify.
Yes. And I actually, he said that in regards to Gorbachev, did he not?
Yes. Yeah. In Russia. Yeah.
I had a chance to meet Gorbachev once. That was interesting.
Oh, how cool!
Yeah. Well, let me. I want to kind of wind down with you and maybe talk a little bit because I want to get some of your perspective, big picture. Look, we're going to go ahead and give your website address and where everybody can reach out to you. But I think ultimately, some of the most important aspects of being a trader, an entrepreneur, somebody that just wants to get ahead, there's just certain personal ways that make a lot of sense to be. And I know clearly by your bio, you've been a fighter. You've definitely fought fights. I'm curious, when you look back in hindsight, do you regret any of your fights, or do you feel like those fights shaped you and gave you wisdom today by going through those experiences? Oh,
I'm certain there's one or two I would regret. I can't recall them. But I think that the temperament of the Montana idea of if you're right, you stand up for it. And if you get beat up, so what? You stood up for what you believed in. And I think that actually helps in trading because you're willing to take a position. A namby-pamby guy who will run from a fight won't take a position in the market. Paul Tudor Jones was a boxer. So many of these traders have been in an aggressive form of something along the way. Charlie DeFrancesco, the largest bond trader in the history of the world, was a great football player. I was a mediocre football player in college. He was great. And I think that aggressiveness maybe, or that willing to take a position, not aggressiveness, willing to say, yeah, I'm in, I think is actually helpful to trading. That's how I see it, at least.
Well, you mentioned earlier, and I didn't get a chance, I didn't follow up on it, but you mentioned the idea of Montana and the bucking bronco. And I was thinking to the big city kid, or frankly, even worse, the suburban kid, the suburban fast food kid. But here you grow up in Montana, the idea of a bucking bronco, by its very nature, is you are going to get tossed off, and you're actually you're judged by getting back on. And I think in a society these days where every headline is, or it seems like a lot of headlines are banning dodgeball. I saw a headline the other day, a little kid apparently, and I'm not condoning any kind of violence, but I did this as a kid. All little boys do this. He held up his hand. He made like a gun symbol. He was like 7 years old, and they suspended him for school for a year. And I think there is I think there's a neutering of society going on, Larry. That's frankly frightening. Like what is happening to us that we think everything is supposed to go in a straight line, and everybody is wearing like some kind of padded suit, and there could be no injury. Doesn't injury teach us something?
Yeah, I couldn't agree more with that. We've tried to have this pasteurized, homogenized society where everybody knows what's best for us. And even if they're right, we never really learn it on our own. I mean, you can read something in a book, but until you experience it, you don't really know it. So, yeah, to get tossed off a horse or get tossed off a bike or a car or do stupid things as I did, as I'm certain you did, as we all do, that was a phenomenal learning experience. And we don't get that much anymore because we're protected. That's a societal change that we're trying to transition through on part of some political people, and the other people are resisting it. That the best learning is from your experience. And certainly Michael Bloomberg saying you can't have a large Slurpee. I mean, come on, Michael. That people will actually rebel at that and have more of them, or they'll order 2 or 3 large Cokes instead of where they would have just had one. So, yeah, it's sad to see. And I think that may be why more people are coming into trading. I've seen really 2 interesting things. People do want some place where there is some exposure to risk and opportunity. And it used to be when I lectured on commodities around America in, say, the 60s and the 70s, it was all middle-aged white male. And about 1980, that started to change, and the people coming in were younger, some female, still not very many, and a lot of first-generation Americans from Germany, from Italy, from India, from Mexico. Suddenly there was a shift. The risk takers in America were no longer Americans. They were first-generation new Americans. They were the ones that wanted to risk. And that really just was a real wake-up call. Like, wow, the people that want to risk are the new generation, not the old generation. You still see a lot of that.
Yeah. You were mentioning about silly things in the youth, and I was just recalling that one of my favorite experiences growing up, I was probably 19, was waking up the next morning and having 2 black eyes, not one, but having 2. And that actually, I don't know how many guys can actually say they woke up and had 2, which means I didn't win, but I learned a lot. And I did hurt one guy in the bottom of the pile. But and I was just on a really kind of more simple level. I should tell you about crossing the street in Saigon. So it's a city of 10 million people. There's 5 million motorbikes. When you cross the street in Saigon, you look left, you look right. You look left, you look straight. You look right, you look left again. You look right. You don't ever stop looking. The risk doesn't stop. And I think that's kind of what you're getting at, is that maybe there's a desire for people kind of, there's a certain segment of the population realizes that frankly, the nanny state is not fun. It's not fun to be put into a padded uniform.
Yeah, all gray is not a pretty color. Sounds like a great place to raise commodity traders. You got to look. And be aware of that much.
Look, and I've mentioned this on some of my other podcasts. I was speaking earlier this spring in mainland China, and I have to tell you, sometimes people think that Westerners will say about the Chinese, their religion is money. I can report with firsthand experience, the mainland Chinese tell you that their religion is money. They don't beat around. I mean, they say we are going for it.
Yeah, it's certainly changed. I was first in China in the late 1970s, and everybody that was there wanted me to bring them home to America. And now when I go to China, I've had 3 or 4 books in Chinese. They want to buy a house from me and have me come live there. I spoke at their Stanford unit, their comparable Stanford lecture there. It's totally changed now that it's opened up, and they really are about making money, which really means they want more freedom, because that's what money buys you ultimately, is freedom, nicer lifestyle, freedom to live a nicer lifestyle. And they really want that, and they are working so hard for it.
Yeah.
It's, amazing opportunities there.
I remember walking down the street this spring, and I passed a basketball court, outdoor court, and there was a bunch of young guys, probably 17 to 22, playing hoops. And I mean, these guys were 6'1", 6'4", all wearing sweatpants, running around dunking. And I was thinking to myself, I don't think a lot of Americans realize that they're handing out milk and meat here these days. And I would tell the Chinese, I said, I said, you guys remind me a lot, and some of these speeches, you remind me a lot of Americans, because in America, American likes everyone to say, hey, we're number one. Well, I'll tell you what, the Chinese view themselves as number one too. And anybody that thinks that it's just an American playing field and it's not global today, I don't know how to convince you.
Well, yeah, that's a great point. It has become more global. And I think in part because America, part of our leadership is backed away from wanting to be number one. We don't want to be number one. We certainly don't have a policy of that anymore. It's, well, we have to be fair to everybody. And we've been colonialist all these years, and we shouldn't be number one. Like, what a stupid attitude. I mean, I don't care if you're Taiwanese or you're a Singaporean or an Indian, your country should be number one for you. You have a right to earn that position. And for some reason, so many people here have just backed off from that.
Yeah, it's interesting. It's interesting that we're talking today with some of your political background, and I had caught some this morning that they were having the great political debates in D.C. about debt ceilings and whatnot. And let me end up with that. Let me let you kind of describe, if you're willing, how do you see? And I think your politics these days is mostly libertarian. Is that correct?
Very correct.
So if you were to give advice to somebody, and because look, I know that if I say the word libertarian, which is where I kind of think of myself, most people will kind of in America give you kind of a slanted eye, like, well, what's that? And still, but why do you consider yourself libertarian, and what are the advantages for you philosophically? How did you get to that point? I know I've covered a lot of ground today, Larry, but you got a lot of experiences. I'm sorry I'm going everywhere.
No, that's fine. It's made it enjoyable. I got to that point because I was tired of seeing politics of either persuasion having a Band-Aid philosophy. Oh, there's a problem, we'll put this Band-Aid on, which is usually more money. But there was no thinking or theory behind why these things were done. Libertarians, whether you agree with them or not, they are consistent in their approach to government. I've known Ron Paul for 35 years. His views today are the same views he had 35 years ago. He is consistent. And I may or may not agree with him on everything, but I know exactly what I'm getting with him. I don't know exactly what I'm getting with most Republicans and most Democrats because they're all over the board. It's whatever panders to people that are going to vote for them or give them money. That's the driving force of their political theory. And I really like to see some consistency in government and how we need government. We need it to do certain functions, and it just needs to be done on a consistent basis. So we understand the limitations of government, as we've talked about earlier, and the greatness of government. And I think that's what libertarians offer is consistency. Might disagree with them, but you know where they're going to stand on the issues.
Yeah, I couldn't agree more. Hey, Larry, where can the audience, and obviously the audience is going to already know where to find you, but where is the best place for them to go connect with you? Your website, your Twitter, Facebook, where do you want people to best be directed?
Well, at 71 years of age, I don't want any more friends. I'm trying to lose some of the ones I have right now. So I have no Twitter.
You don't hold on. Does that mean you don't want anyone showing up at the Virgin Islands, knocking your door and saying they're going to take you to lunch? You don't want any of that?
We've had that happen. But the best place is our website, ireallytrade.com, because even as an old man, I still really trade. So ireallytrade.com. There's a lot of stuff there, a lot of free stuff, and we're not much into marketing anymore, but that's the best place to reach me.
Okay. Well, how is the? Well, I've been to St. Thomas, but
I can see it across off my out of my window. I can see St. Thomas today.
How's the weather today?
The weather's beautiful. We kind of live in perpetual summer. The tax code here is so great. If you qualify, your state, federal, and local tax is 4%. It's actually 3.9. We call it 4%. So there's a lot of traders that have moved here, publishers that moved here, a lot of software companies, because 4% state and federal tax is a heck of an advantage. So it's an interesting community.
Yeah, I was down a couple of years ago speaking with some guys that had set up shop down there. Yeah, it's definitely interesting. Well, listen, Larry, it was great. I appreciate you coming on today and offering all kinds of perspective.
Well, I am honored to be on your show, Michael. Thank you so very much for having me.
Well, I appreciate it. Look, people, I think it helps so many people to hear. I mean, they can always hear me rambling on about whatever, but I think when they hear different perspectives, people that have led interesting lives, people that have taken chances, take risks, it can only help other people to say, hey, hold on, I don't have to just sit in an office cube for my whole life. I can go do something. And so I think you've definitely done a lot of different experiences, and I hope people learn from that.
I hope so too. And that is a wonderful thing about trading, is the lifestyle that it can create. If you want to make a big business out of it, like some of the guys have mentioned, or you want to be like I am, kind of a free spirit, do a bunch of crazy things in your life, you can do that. It leaves the canvas wide open for you to paint the picture, because you have control of your life as a successful trader, not a boss, not a company.
Yeah. Larry, once again, thank you. And hopefully we will talk again on the podcast.
I look forward to that. Thanks so very much.
So this is probably one of my breakout podcast episodes. Breakout in the sense that it's not a pure trading or trend following episode. My guest coming up in a few moments here is Mike Aponte. Mike he's a professional blackjack player, and he was a team member, a leader of the famed MIT blackjack team. So Mike is a professional card counter. He's definitely not a gambler. He's an investor. We're going to talk about that. And for those, if you really want to look at more information on Mike, but he's featured in the book called Bringing Down the House by this guy named Ben Mesrich. It was a bestseller. And he is the character in there, Jason Fisher. And it was also made into a movie called 21. The only thing is of 21, though, is that 21 was an adaptation of the book. So it's more of a fictionalized portrait of the book. But in the book, Mike talks about this. The book was somewhat accurate. But anyways, I think it's a really interesting conversation. Now, if you're immediately hearing this intro and you're saying, oh, I'm just interested in trading, I could care less about this blackjack player, that could possibly be one of the most boneheaded things to say. The synergies between blackjack, successfully playing blackjack, and trading are off the charts, all the way down to one of the key linchpins between the two, Ed Thorpe, and something called the Kelly criteria. So anyways, enjoy. It was a fun conversation in person, Laguna Beach, California, with one of the best views of the Pacific that I just want. I just want to be there. That's what I want. I want that view on one of those cliffs right there in Laguna Beach. So anyways, hope you enjoy it. Let me start, Mike, with, because we're roughly about the same age, early 40s, and I want to kind of take you back to just briefly in the beginning, that you got started in your world, in the world of 21 in 1992. That's placing it right?
Yeah, that's about right. 1992, my senior year at MIT.
Yeah. So before that, you really had you ever been to Vegas or?
No, people always assume that because of my card counting background that I grew up playing cards and was interested in gambling, but it's actually quite the opposite. I never played cards. I had actually no interest in casinos, but obviously when I learned about the card counting, it's a completely different game and approach than just gambling. So that's what really kind of caught my interest.
So you basically, just like maybe the average person, you knew Vegas casinos, there's these games, maybe you had heard ideas about somebody could beat the games, you knew something about odds. Clear, you're a bright guy, you did well in your math SATs, I'm guessing.
Yes, pretty much everyone at MIT.
I think you did better than I did on mine. But okay, so you get into you're not in you've left MIT. You've either left because you weren't on the team while you were in school, or did you finish school? Explain how that unfolded.
Actually, initially I was in college. What's very interesting was that the team that I got recruited to play on, it was a startup business venture. It was actually a limited partnership, and they had a business plan and raised $1 million in capital, which most people aren't aware of. And it was aptly named the Limited Partnership Strategic Investments. So it was started by, it had 3 general partners, one of whom was a Harvard MBA grad, and the other 2 were MIT grads. And they had come to know each other in the early, mid-'80s when they were dabbling in card counting. So their business plan was to recruit MIT students, train them how to count cards, and then have, of course, rake in all this money. So it seemed like a great idea on paper.
You know, we'll circle back at the end and kind of bring in some trading ideas, but I just want to interject at the beginning here because I don't know if people know this, but one of the folks that really mentored me and gave me a lot of great insights is a guy named Ed Sakota, MIT grad, and Ed is basically known for putting together the first systematic trading system on punch cards while at MIT.
Wow!
So this was his. You definitely will have to go meet him. You've got an in with at least the schools. Well, take me through. So you get on board this one team, Strategic Investments, and you're cutting your teeth, so to speak.
Yeah, I mean, I was excited. I was like any 21-year-old would be. I mean, the chance to become a high roller and obviously kind of the idea that you could actually legally beat the house at its own game. That had a bit of a Robin Hood type feel to it.
Well, that's interesting. I have to point out that you just led with the idea of high roller versus beating the house. So what was the motivation? You led with the idea of high roller versus beating the house.
Yeah, I have to admit, initially the perks were naturally what attracted me, and then when I really learned what it was all about, because before I got recruited, I had never played a hand of blackjack. I didn't know anything about card counting. But once I learned how it worked, how it was systematic, mathematically proven, and I really came to enjoy the challenge of trying to execute that system perfectly in a casino environment while appearing to be your typical losing gambler. So it was both, of course, founded on a science, on mathematics, but there is also very much an art to high-stakes card counting.
A heart.
An art.
Oh, an art.
Yeah, a whole art to it. Because
there's some heart, too. There's a passion. You obviously had a passion for this. You weren't going to be successful unless you really wanted to do this. You practiced like a crazy person, correct?
Yeah, like in any field, members of the team like myself, the ones that became really successful were the ones that were dedicated to it.
So you might have had a little bit of extra, call it genetic luck, maybe to do very well in your math SATs, but you practiced. There's plenty of guys that did well in the math SATs, but they didn't do what you did.
Exactly. Because one of the questions I'm most often asked is, what does it take to become a card counter? Like a lot of people assume, they've seen Rain Man, or they hear about the MIT team, they think that you have to be a math whiz or have a photographic memory, but it's actually nothing like that. It's really the most important criteria is you have to be committed and willing to put in the time. It's discipline. Of course, it helps. I mean, you need to be comfortable with numbers, doing basic arithmetic, but you don't have to be a math genius by any stretch. There's no trig, calculus, geometry, algebra. It's literally middle school math.
And that is I think, whether it's the blackjack world or the trading world, that's often a first preconception that you do have to be. I think if you, I'm going to guess with the MIT situation, I can think of my book, the Turtle Trader book. I think that perhaps the powers that be set up these filtering mechanisms because they felt like, well, let's if we're going to choose people, let's choose people that have really achieved on their math. We don't have to worry about that aspect. But as you said, there's still a whole other aspect to it. The discipline, the passion, the perseverance.
Yeah, no, actually you hit on a very important factor as far as success in card counting is that, yeah, it did make sense on paper to recruit people from the MIT community because naturally you wouldn't have to, mathematical aptitude wasn't going to be a concern. But one of the things that was soon found out on strategic investments was that there was a lot more, actually probably more important factors than math ability in terms of winning the casino, like the discipline, preparation, and kind of like a general, for lack of a better term, street smarts. I think that applies to most professions. You kind of have the technical, the skill aspects, but then there's always those more intangibles that are very important that one has to have to do really well.
Well, let me. You've got a certain amount of fame in the 21 world, and probably for folks that have read some books and seen some movies. But I want to give you the chance to kind of lay some things out, because I've learned a couple interesting things about you. I sat down the other day and I was like, God dang, I got to read this book. I got to read this book really fast. I haven't had a chance to read it yet. So I read, it was at Bringing Down the House. And before I started to read that, though, my friend, she's like, nah, just watch the movie. So I rent the movie and I start to watch it. And I'm like, well, hold on. Is this movie a fictionalized account of the book? And then what part of the book is fictionalized? So I quickly realized the movie was fictionalized. So it's like, I can't watch this. And then I started to read the book, and I'm like, okay, what percentage of this is fictionalized? And then when I started to look at your bio, I was like, okay, Mike, who, for those that have read the book, Mike is this character, Jason Fisher, in the book, or at least portrayed that way by the author, that you had not talked to the author until after the book was published.
Exactly.
So I'm like, okay. And then you were essentially the leader of the team, and I'm sitting here thinking, okay, let's don't do the tired old interview. Let's let you tell me a little bit about how things really went down. And perhaps maybe the best way to start is maybe if you just want to kind of hit on something that people maybe have read in the book that was just 100% not true.
Well, what's interesting about the book is that I'm probably one of only a few people that I know exactly where the author, how he kind of pieced together and put together the book. I do have to say that the book overall captures a general timeline of what we accomplished. Things are kind of out of order because obviously he only talked to one person on the team. So he's taking that information, that secondhand information to a large degree. And of course, a big part of his goal was to make it very entertaining, and so interject some artistic liberties. But one of the questions I'm often asked is about this underground casino in Chinatown in Boston. Like, people ask me about that, and I've even met a guy who's like, oh, you got to tell me where that casino is in Chinatown. And that part was actually fabricated. And the inspiration for that part of the book was there was one Chinese New Year's. We had a good friend of ours who wasn't on the team, who was really kind of the king of the Asian nightclub scene. And so he invited us to this kind of private party in Chinatown. And when we showed up, we were both surprised but really happy that they actually had a few tables of blackjack. I mean, this was just more so for fun, and people were just betting $5. But of course, our nature kicked in, and we asked what the table was.
We have to win.
Well, we asked the guy who's running the game, what's the table max? And he hadn't even thought about it, really. He's like $25, which is actually higher than, he's taking on more risk. And then we just kept thinking of other ways to get around it. We said, oh, well, can we back bet each other? Which means, if we all back bet each other, there's three of us, we essentially have raised table max to $75. And of course we said, oh, you have to have surrender and all the great rules. And then they were dealing out of 4 decks, which is actually even more favorable than 6 decks. And the big kicker was that they didn't have a cut card. They would deal down to the last card, which for a card counter is that just doesn't happen in actual casino play. So basically you get to utilize all that information to the end. But I mean, to make a long story short, it took us like about an hour and a half to break the house. We won about $4,000.
I'm sure they were happy.
Yeah, we settled up at $2,000. We gave them 50%. I actually felt kind of bad But yeah, just it was kind of like sharks in the water. We couldn't help ourselves.
You know, I do have to interject that in the book, Bringing Down the House, Mike is portrayed, and I'm sitting here in front of him, so you know, he's a good shaped guy, you know, he's a good sized guy and everything. But in the book, he's portrayed is almost a fire-breathing NFL linebacker, apparently looking to get into a fight at all moments in time. And I could safely say that is not an accurate portrayal, unless there's some dynamic other gear that kicks into place when everything's on the line. I'm not sure.
I mean, I do have to say back during my playing days, I did lift weights religiously, so the author kind of got that part right for that period. But yeah, I'm definitely a laid back type guy. I think the reason why he made me out to be kind of this tough bad guy is, one, being the leader of the team. I guess when it came time to crack the whip, that kind of fell on me by default, just because we're all good friends, and it was very much the opposite of like a corporation or your typical work environment. So when it did come time to, you know, kind of like the fire, that was my responsibility. But I think mostly he did it for the entertainment value. So
yes, he needed to tell a story.
Exactly.
He needed a story. He needed characters. Let me. He's not leaving yet, but anyways, we're. I just have to paint the picture for folks. We are outside a cafe in Laguna Beach, California. There's a view of the Pacific that, yes, with today's weather, I'd say it's about 70 degrees. There's not a cloud in the sky. I don't know if you could really sweat in this weather, but the view of the Pacific is, you know, people say, oh, California this, California that. I'll tell you right now, this view of the Pacific right now, Mike, I have to, you can't go wrong with that view, can you? You can't go wrong with that view. Let me take this into, since I've had the good fortune of having you here. Well, actually, one more thing I want to bring up just about the book. The book was very honest about this. The book describes the appropriate ethnicities of the players. The film was a whitewash. What's that all about? What was that all about? Like, so all these very smart Asian American guys and gals are basically a part of this team. And then the film comes out, and we got a bunch of pretty white boys in there. What's going on?
That was pretty disappointing. I mean, obviously their justification, unofficially, I'm sure, was, you know, we're making a movie and we want to try to make it most appealing to the mass population, which I kind of understand. But even taking the race factor aside, for me, it was just disappointing from an authenticity point of view.
Yeah.
And also the fact that our big players, the guys like me who put out the big money, the fact that we were Asian was actually very important to our success, because being, you know, in our early 20s, that didn't really work in our favor as far as being high. I mean, because there aren't that many, you know, 21, 22-year-olds betting, you know, $10,000 a hand. But being Asian actually was a huge advantage, because there are, I'm sure if you've been to a casino, there's a disproportionate
I have been to the
number.
Venetian and several casinos in Macau, China, and you know, people think they've seen gambling here in the States. No, it's very serious stuff over in Asia.
Oh yeah, Macau and Singapore, the two biggest gaming revenue cities in the world. Singapore has just overtaken Las Vegas.
And the funny thing is, have you been over there? You've seen those casinos, some of those over there?
I heard they're palaces.
The Venetian is, I think, with the largest casino floors in the world. And you walk in, and you know, if you walk into a casino in Vegas, it's like it's a shit show. You know, there's people this and that. Not in Macau. It's like, you know, serious people, no noise, concentrating. It's not a show. There are Asians who are very serious about gambling. As soon as they land in the city, they go straight to the airport and literally straight to the table. And some of them will be at the table 24, 48 straight hours, and they'll take their meals there, and they'll have a small, like a bed set up by the table. These are obviously the high rollers, and they'll take a quick nap there. They're hardcore. You almost wonder if it was, from a marketing perspective, if they were really short-sighted and not thinking about the global aspects of this story and film, and who are, let's face it, when it comes to we're going to talk about the difference between gambling and investing in a second. When it comes to gambling, I think Asian gamblers are at the top of the heap, aren't they?
Oh yeah, they're the most coveted casino marketing department. They have whole departments dedicated just to the Asian clientele. So for myself and the other Asian big players in the team, that's really what enabled us to play. Because the reality is, if you're a 21, 22-year-old Caucasian and you start betting huge money, that's kind of the stereotype of a card counter. And so we kind of used that profile. We kind of used that against the casinos.
Kind of like reverse discrimination almost. They're kind of not even realizing that they are discriminating, but it's actually hurting them.
Exactly.
They think it's helping them, but it's not.
So yeah, that was disappointing just in terms of the telling of the true story and a big and important reason why we were so successful. Not to mention that MIT does have a significant Asian student population as well.
Well, it's funny. We could go into a conversation as to why. I personally would describe a lot of it. I'm sure there's some genetic factor, but I think it's too easy to say that because I have a ton of Asian American friends in the States, very, very bright, and I think when people, especially Caucasian folks in America, they'll often think, oh, there's some genetic component. All these Asian folks do very, really well in their math SATs. That's not fair. It's a practice thing. It's a practice and it's a hard work thing. And I have a friend right now who's raising a 2-year-old, and she's of Indonesian descent. And just to watch how she works with that child at 2, I didn't see that with with people that I knew. So it's very different. I don't think people sometimes think about this, how early it starts and how different it is.
Oh yeah, it's being coming. My mother is Asian, so I know very well. It's all about environment. It's an environment and expectation. That's Asians. Yeah, they don't have a natural advantage. It's I'm a big believer in phenotype over genotype, as you are, right?
Yeah, absolutely. Well, listen, let me get you into some of your wheelhouse. Some of your wheelhouse here is people in $100,000 Mercedes are honking at us because they don't have nothing better to do in Orange County except imagine being themselves on one of these OC shows. I think we're in the middle of that. This is like probably a casting call for one of these OC reality shows. That's what we're in the middle of. Let me let you jump in though. Gambler versus investor. I mean, that's your life is centered on this. You know, most people probably hear what you do and they're like, "Yeah, you're just a gambler." That's not true. You're an investor. Why don't you explain that?
Exactly. That's one of the things when I do corporate events, speak at universities, that people, it sounds funny to them when I say we weren't gamblers, we were investors. So I think very much as in the stock market, which you know better than I, it's all about the mindset and your approach. That's really what differentiates a gambler from an investor. So when we played in the casinos, it was really interesting because we were on one end of the spectrum, probably like the top 0.1% of blackjack players, and then everyone else, they were on the other end of the spectrum. They were the gamblers. You know, they played based on superstitions. You know, everyone had the lucky feelings, the perception of hot streaks. You know, cold dealers, and largely misinformation. The way they would form their playing strategies was based on just short-term observation, what they'd hear from a friend, some advice they get to a dealer, and in a very short time, to them, that becomes, they've come to believe or convince themselves that that's the best way to play. Whereas our team, everyone on our team, including myself, never gambled before, and I think that was a huge advantage. We started off with a clean slate. We learned, a mathematically proven system, starting with basic strategy, which is how to play your hand correctly in every situation. Like, you should always hit a 12 versus 3, for example. A lot of gamblers will waver between hitting and standing and kind of flip-flop. I mean, the key is to be consistent and get the long-term payoff from that. And then as far as the betting, most gamblers will just bet based on a lucky feeling, or even worse, when they've lost. They're chasing their losses, which I'm sure happens in trading all the time. Or, they're just upset. That based on emotions, they're angry. Whereas what we did, professional card counters, we bet bigger when we have a real advantage. We know for with 100% certainty that we have an edge. Of course, that doesn't guarantee we're going to win that hand, but if we just repeat getting that betting volume, maximize that betting volume with an advantage, then that's when we're going to reap the profit. So basically, we just took the casino model and we reversed it, and we used that in our favor.
So you talk a little bit about the psychology here, and like some of the notes that I've got. Gamblers, clearly, it's greed and fear. Same with traders. Bad traders and gamblers, not being investors, they're motivated by greed and fear. Do you ever recall at any point in time, whether it was one of the biggest hands you had, one of the biggest wins, was there ever a feeling? Were you successfully? Clearly, you were successful at it, but getting your mind to view the wins and losses on the same emotional keel. Were you obviously were pretty good at that?
Yeah, well, I'm kind of naturally even-keeled person, and what makes, because blackjack, as you know, like trading, has huge, big fluctuations. Even if you're a professional, even if you do have an advantage.
You want to move out of the sun to yourself as well.
Yeah.
If you're frying.
So, but yeah, when you put out, 3 hands of 10,000, and the dealer, pulls a 21 out of nowhere, that's
still affects you.
Yeah, you're not happy about it, but
you've got the longer term game you're playing in your mind is still there. So you kind of quickly say, okay, that fully could have happened and it did happen, but now I have to move on.
Exactly. That's what you can always fall back on, that we have the skill level to apply the system, which gives us an advantage, which will pay off in the long run. So short term, there's definitely little highs and lows, because if you put out big money, no matter how long I played it, it's always exciting. And I wouldn't put out the big bets to create that excitement, but it's exciting in the sense that, wow, this is what I've been waiting for. This is what I've been working for. This is why I've been patient. And now it's time to capitalize on that. But it is always nice to, if you do happen to have a losing streak, which you'll have. We had, personally, the most money I lost on a trip was $60,000. And I wasn't happy about it, but it wasn't, that's just part of the whole probability distribution. You're just going to have fluctuations like that. But on the flip side, the most money I ever won on one trip was over $200,000. So your wins tend to be bigger than your losses, which from what I understand, is very similar with
Absolutely.
the successful traders.
It's funny, just for some perspective. I'll give you some more information on this too. But there's one trader I have in mind who has a track record dating back to 1974. After fees, his track record annual basis is about 19%, back to 74. And during that stretch since 74, I don't know how many drawdowns he's had from peak to valley that have been over 50%, 5, 6, 7. So think about that. That's a heck of a road to travel, but the fortune he's made is off the charts. And I think and you might want to speak to this as well too, is the aspect of volatility. Volatility is not necessarily your friend, and volatility is not necessarily risk.
Yeah, as far as blackjack, professional gambling, volatility is definitely not your friend, because relative to the casinos have an infinite bankroll. And even if you are a good card counter and you do have an advantage when you play, if you're not practicing proper money management, then you're essentially almost playing with the loss goal. You hit that one bet swing and you're tapped out.
Well, you bring it up, so we'll just go right into it. When you talk about money management, a lot of people have seen my writings and they know talking about money management. And most good money management has its, whether it's trading or blackjack, has its roots in the same formula. And I'm going to let you be teacher for a second and let you explain it from a blackjack perspective. And people can go look it up. But the Kelly formula is where good blackjack strategy is derived from. It's from where good betting strategy in trading is derived from. And I don't think you can find any good trader in either one of those spheres that in some way or another is not applying this formula, whether they've augmented it but it's the foundation. Why don't you speak to that?
Yeah, I mean, it's betting. Our whole money management philosophy and approach was based on the Kelly criterion. And it's very simple but powerful. So the Kelly criterion, in order to maximize, if you want to maximize your long-term gain, then you would bet a percentage of your capital or bankroll that's equal to your advantage at that point in time. Now, doing that will maximize your expected value, your expected win, but it's also going to create some pretty huge swings. So what we did, and all successful card counters and traders do as well, is we wouldn't bet our full advantage, we'd bet a fraction of that. So for example, if you had no concern about risk, then you would play a full Kelly criterion, a Kelly criterion of 1. We played a Kelly criterion of 0.4. So that way, it was it's going to be a bit of a trade-off where, your expected win is going to go down because you're not betting as much, but the volatility goes down as well. So you can ensure that you're going to get yourself to the long run. So for example, if you bet a full Kelly, there's over 50% chance that you're going to lose, more than half your bankroll at some point, and that's a lot.
It takes a constitution to hang on, a certain constitution of the stomach to hang on to that kind of a drawdown and that kind of variability.
Exactly. I mean, gaining an edge that's the first step. That's very important, but it doesn't do you any good if you can't get to the long run.
That's another, as you bring up these terms, it's another kind of foundational thing to trading. And, essentially with, say, the trend following world, you might have, 30-40% winners, 50-60% losers, and maybe, for every, your big wins, you're going to get 3, and for your losses, you're going to get 1. So the whole idea is cutting your losses short, having small losses, big winners, and trying to end up with a positive mathematical expectation. So, and it's the same formula. So, very simple formula. But speak to me about the inputs to get to the expectation in blackjack. So, how would that unfold? Just in a basic mathematical expectation formula.
Well, that's one of the beauties of professional blackjack, is that the whole framework, the whole system is very much black and white. And we didn't invent this. It was Ed Thorpe, who I'm sure you're Professor Ed Thorpe, who I'm sure you're very familiar with. He's the father of card counting. He's the guy that figured out back when he published the book in 1962, Beat the Dealer, that blackjack is a game that's based on...
I'm going to test you. I got a bunch of Thorpe stuff here. You're going to get tested.
Events. So in blackjack, the big if in blackjack isn't so much if the system's valid. It is. It's been mathematically proven by people far smarter than me. The trick is, do you actually have the skills to attain that theoretical advantage? So that's why our training was very important. But as far as card counting, it's very straightforward. So when the count reaches certain levels, you're just going to bet incrementally a number of betting units.
It was great.
So
it was great. I had an
that's why trading is, I think, tougher. There's a lot of similarities, but trading is tougher because it's harder to gauge in trading exactly what your advantage is. Whereas in blackjack,
you can't rely on the mean reversion completely in trading. You just can't. It's the moment you rely on that is the moment some of the most famous hedge funds go bust.
Exactly, because the dynamics and the market, the variables that go in, they're subject to change. So a system that can work great for 10 years can just go away.
Blackjack, so to speak, is a closed system. I mean, is that a way to think about it?
Exactly. It's a static model, and the only variables that do change would be like casino rules and so forth, but those are very well defined and you know that ahead of time. So there's no surprises. So the only thing that you have to deal with in blackjack, provided that you have the skill level to reach that theoretical advantage, is just volatility. But that's very straightforward too if you practice sound money management. So that's what made it. That's one of the things I loved about it. It was a very black and white system, so that made it very easier, I should say, in terms of reaching certain goals and training, bringing in new people and training them.
Well, I'm sure you've read this, but I'm looking at one of Thorpe's papers. It's like, he leads with it. It's like the central problem for gamblers. Now, when he says gamblers, I guess, we've just had this conversation about gamblers versus investors. I think what he really means is for gambling investors. The central problem for gamblers is to find positive expectation bets. Mm-hmm. But the gambler also needs to know how to manage his money, how much to bet. And that's the magic elixir. I think when you look at anybody that's had success in your world or in the trading world, it's really the betting issue. Because if I give the hierarchy of needs, so to speak, in trading, there's some argument, but so there might be some that would say it starts with portfolio selection or money management. You could flip those, and then it's like, what can you really control in the trading world? When I can take a loss. You can't control how much you can make, control how much you can lose. And then the last thing is entry. So it's it all starts with I guess as you kind of hinted at some of these things people traditionally think of as being part of successful blackjack playing, their observation and stuff. But those are the minor details, and the critical one, as you're talking about, is the bet sizing, the money management.
Exactly. That's in blackjack. There's only two types of decisions you can make: playing decisions, that's taken care of by basic strategy, that's the set of playing decisions that's going to maximize your expected.
Basic strategy is not just the word basic strategy. That's basic strategy. When you define that for just really quickly, so people know that we're talking about there.
Well, for every single hand in blackjack, there is one and only one correct play. So for every new recruit on their team, their first and only task was to master basic strategy.
And that's called basic strategy.
Exactly.
Just so people know.
It's called basic strategy. It's actually Army mathematicians.
You guys give it a really complicated sounding name. It's almost like hidden in plain view.
It definitely kind of belies its importance, the name. But Army mathematicians in the 1950s actually derived basic strategy. And then Ed Thorpe, he had an advantage that he had access to the supercomputers at MIT, and he confirmed that their basic strategy was correct. But in terms of getting the most bang for your buck at a blackjack table, basic strategy reduces the house edge by about 75%, because your typical player is at about a 2% disadvantage to the house. And if you play perfect basic, it goes all the way down to 0.5%, which is huge. You're losing 75% less money.
So the weekend warrior can actually, just with basic strategy alone, can make his weekend a lot more fun.
Oh, exactly. When you factor in the comps, which a lot of people enjoy, you're going to be breaking even. And if you were to take it even a step further and to play at casinos that have the best rules, like dealer stand soft 17, surrender, which is an option where you can get half your bet back on your first two cards, and resplit aces is obviously a good option for obvious reasons. With those rules, if you play perfect basic, then the house edge is only 0.26%. I mean, you're practically break even. So, I mean, naturally, when people think of an MIT card counting team, they think of the card counting, the counting aspect, but that is important. But without the basic strategy, the card counting is not going to be able to put you over the top.
I have to tell you, there's something came up in my world that really only made me think this way after reading the book that you're in, and that was the team approach. And your team approach, where you would have the big player, the BP, right? The guy that's really done his homework, practiced more than anybody else, has had more success, yada, yada, yada. Then maybe some of the newer recruits would be serving the role as a spotter, essentially figuring out when a table needs the big player to walk over and really apply big piles of money when the odds are in the favor of the big player. Am I describing this right?
Exactly.
Well, in trading, the month of May was an exceptional month for trend following traders. And I was just talking with a hedge fund buddy on the drive up here, and we were talking about one trader who made over 40% in the month of May. And my thought, and he's had some variability in his performance, but my thought was, what's the real story? Like, Most other traders in the trend following space did not do 40% in May. Why were his numbers so much greater? Was he concentrated primarily in crude oil, which took this big drop, so he made a massive amount of money in the short position in crude oil? So was that what he was doing? And I start to think about what's really going on that allowed this one trader on the edges of all the other traders to do so much better. And he could have been carving his trading up in a collaboration with other people, very much like you guys were carving up a casino floor.
Yeah. No, that would make sense.
Yeah.
It's the first step, which most people cannot do in blackjack or trading, is to have a real edge. But then to make real money, you're going to have to get the volume of advantageous trading, trades or betting situations in blackjack. So for us, the team play, what that did, it maximized our expected win, because a big player that plays by himself can only play, 4 shoes an hour maybe. Whereas if a big player teams up with spotters who are just simply watching the tables, then now our sampling rate goes way up.
So no one noticed that you guys would just run from table to table winning all the spot. Actually, they noticed at some point in time.
Well, initially they didn't, and
the casinos are a pretty busy place.
Exactly. I mean, most and for us it was also, we were the beneficiaries of good timing, because when the team that I played on when we started up, Vegas was really starting to grow. You had these new casinos springing up, and there was a lot of competition for the premium, the bigger bettors, and also many new people in the industry who are not as knowledgeable. So a lot of times you have to be lucky, as there has to be a luck component when you have success in a particular endeavor. But with the spotters and the big player, that enabled us the big player was just jumping around, just only betting. All the big bets are at an advantageous with an edge, and we don't have to pay any rent. We would call it, a term for it is rent, or we wouldn't have any negative expected win while we're waiting for the count to go up, because the spotters are just simply watching the tables, right? I'm sure in trading, a lot of times you keep your trades small, right? But what would be even better when you don't have an edge is not to trade anything.
Not to play.
And that's exactly what that enabled us to do. And at the same time, we had a second benefit, which was almost or equally important, was that it provided a camouflage for us, because a card counter, your typical card counter will sit down at the start of a new shoe, put out start off with a smaller bet, and then as the count increases, we'll bet bigger. Well, with the BP strategy, with when I would be jumping around from tables to table, they would just think I was a crazy gambler. How could I possibly? They never even crossed their mind card counting.
I'll give you an example in the trading world where that kind of dovetails. If you look at I described that one track record of this one trend following trader back to 74, and with these massive peaks and valleys. Well, if you look at that track record, one of your first thoughts is, well, look at those peaks and valleys. They seem to be somewhat consistent. Well, yes, they are, and I'm sure he knows it, and other people know it. And so one of the things that happens with the trend-following trader, if you know he will put in these 50% drawdowns every 3 or 4 or 5 years, well, it can make more sense to allocate more capital to him in the middle of a drawdown. Whereas most people want to give their money to a hedge fund manager when he's in the nightly news and he's just produced 100% for the year. So mean reversion doesn't necessarily work, I don't think, is well in pure trading. But I think if you look at mean reversion from the standpoint of the equity curve of the trader, it's very interesting. That also reminds me of you guys moving from table to table, essentially trading your equity curve a little bit.
Yeah.
That makes sense. I mean, yeah, clearly makes sense to you. I mean, you know what the hell I'm talking about. Let me. One thing I wanted to bring up, though, too, just because it's something that I saw recently. The one time that you got, I think the phrase is backroomed. Yes?
Brought to the, escorted to the back room of the casino.
Right, where everyone wants to imagine they pulled out a tire iron and started whipping you around. This was in Louisiana, right?
Exactly. I mean, it's ironically...
This is not the state to get in trouble, Mike. This is the one state with a legal system that is really not a good place to be in trouble. and they put more people in jail in Louisiana percentage-wise than anywhere else in the country.
Well, and on top of that, I was on, not only was I in rural Louisiana, but I was on an Indian casino, which is technically, that's a different sovereignty.
So you're in the Deep South on an Indian reservation from a Northeast mathematical school with an Asian background.
Exactly.
The odds weren't good.
That was the first and only time in my blackjack career that I was a little scared. And actually what got me scared wasn't, it would have been different if they told me, oh, we know you're card counting, because card counting is 100% legal. But the reason they brought me to the back room was, for some reason, they suspected that I was using a computer to gain an advantage at blackjack. And that's a felony, because you're not using your natural ability. So yeah, to sum it all up, like you said, I'm in rural Louisiana, I'm Asian background, I'm on an Indian reservation, and I'm accused of a major felony. So that was the first and only time that I kind of spilled the beans. I told them, I was like, yes, I'm counting cards. I explained
and
exactly
I'm good at it,
but I'm using my head. I'm not using a computer. And, but yeah, so it was a pretty nerve-wracking 15-20 minutes. I was kind of detained in this room with like this 6'4" bodyguard with the handlebar mustache, or a security guard. And then during that time, they were convening to decide kind of my fate. But then after that period, when the casino manager came in, he actually smiled and extended his hand for a handshake, because they had concluded that I wasn't using a blackjack computer. So the only reason I can think that they would even suspect that was that they don't get much excitement there. And what got me on their radar was that by that time I had been playing for a while, so I was kind of in that black book, that casino black book. They told me they recognized me from the black book, and they knew I was from the MIT team, so they probably just imagined the most exciting scenario where, we're using computers and some other high-tech devices. But it was bizarre, because after it got resolved, the surveillance director came down, and he told me, he's like, oh, it's an honor to meet you. I've heard a lot about your team, and he wanted my autograph, and it was just bizarre. I mean, I was so exhausted and just worn out by then. I just wanted to get out of there.
Let me ask you though, what are some of the things that when you've done a ton of interviews, you talk to people about your background and stuff. What are some of the things though that when it comes to success, and maybe we've already talked about it, I'll let you reiterate, but what are some of the things when it comes to success in blackjack that people don't think about, or they don't ask you about, or they gloss over? They don't understand how much that part is critical. We've talked about the money management, psychology, but are there issues that come to mind at the top of your head when I ask that kind of a question?
Well, as far as card counting, I think a common mistake is that, because it's not rocket science. You can explain, I can explain to somebody in 5 minutes how all the principles behind professional blackjack. Like, I've never had. So
you really don't attribute this to the fact that you studied like a crazy person as a youngster, you're valedictorian at your high school. You really don't attribute it to that. You attribute it more to the fact that, like, yes, I had these achievements academically, but you don't necessarily correlate the blackjack success with those academic achievements.
No, not at all. I mean, it certainly is a plus that that I enjoy math. But we had people on the team who were great at math. Thank you. Even better at math than I am, who just didn't make the cut. It had nothing to do with mathematical ability, but just had to do with kind of having the nerve and kind of those intangibles. Because some people, we had some recruits on the team, they would just get nervous. They would get nervous putting out the big money, which I'm sure that's a big factor in trading too. Like, at some point, you have your system, you have an edge, but you're going to have to trade and put money at risk. And I found that dumbfounding, because that was just counter to, if you have an advantage, I mean, what is there? There should be no, there is no decision to make. You put the money out.
Well, it's funny too when you talk about the size of the money affecting people. But you used units too, didn't you? So like in the trading world, you're not necessarily, if you divide things into units, in the trading world, you're not necessarily thinking about the value of the unit. Same process in blackjack, right?
Exactly. We would raise our wagers in increments of our betting unit, which was a fraction of our overall bankroll. And so I kind of had an expression in that when you've really truly mastered card counting, when you play, you're not really making any decisions. The cards make all the decisions for you. And I'm sure that's probably... I'm sure that's similar in trading too, that once you have the indicators, there's all the emotions taken out of it. You are making decisions in a sense, but you're following an established system. There's no...
you have to map the system out first. You have to figure out the rules and write them down. Then you have to codify those rules. But if I was to tell you that there are $20 billion funds out there, plus that are 100% systematic, I mean, somebody's got to turn the computers on. Someone has to make sure everything's done right. You can't just, maybe something something might go wrong, but the systematic aspect is there.
Exactly. Yeah, the decision-making process is black and white. And so, as a card counter, you just raise and lower your bet based on the count. It's not like you're saying, oh, I should bet more this round. It's the count dictates it. Basic strategy dictates all your playing decisions. And that's why it's so important to kind of master that strategy inside and out, and the skill component. Because there's the knowledge component always comes first, but then card counting, where most people fall short, is that they don't develop the skill. Because there's a big difference between knowing how something works and then being able to apply it. So when you ask, like, what is one of the biggest keys to success that people often overlook, I think it's this human nature that want to rush through and think, oh, I understand all this conceptually, it's not that complicated, but there's no shortcuts. You got to take each step and master it, take it from a knowledge to a skill level where it's automatic, because all those little details or little holes, they add up, and then essentially you're still gambling. So that's probably the number one mistake that at least clients that I've worked with commit. They're not willing to put in the time. It's not complicated, but they're just kind of a little lazy.
Let me ask you this, because and my reference is some of the things that I've seen about you online, which I know are accurate because there were interviews with you and some of the information from the book. But clearly, once you get past basic strategy and proper bet sizing, having teams enabled a whole different aspect of things. And clearly, the book details some of the strategies by the teams and generally how you did things. Can this still be done today in similar fashion, or it can be done, but you're just not going to tell me all the things that you've figured out since that still work, because then that would defeat the whole purpose?
Oh, it can definitely be done. I mean, there are actually teams out there now. I know for a fact. I think, as in any field,
you know for a fact.
I know for a fact. Well, I'm plugged into it.
Mike is plugged in and knows for a fact there's other teams out there. Interesting. I have a feeling he's not going to give any more details, but interesting.
And the casinos are aware that they're out there too. I mean, it's not a big industry secret. Now, as in any field, you're going to have to make kind of the core strategy stays the same, but how you apply it, you're going to have to modify that. Because doing exactly what we did on that scale, it'd be tough to do that, get away with it, because the casinos got burned by that. So the card counting is the same. You just have to apply it a little bit differently as far as the team aspect in order to get the longevity in.
Excuse my crunching. That's sushi. Good sushi here in the OC. Let me completely unrelated as we challenge sushi. What do you think? What is something as someone who's spent a lot of time in Vegas, and we were talking off the record, and we don't necessarily have to talk about what we were talking about off the record, but what would you? How would you describe Vegas to people? How, in a nutshell, having spent as much time as you've spent there, how would you describe Vegas? What is Vegas to you? How do you think about it? You can be perfectly honest, even if it's what we said before.
Vegas, to me, naturally is going to be, I view it through a different lens than most people. Given that when I would go to Vegas, it was for business, and I've been there, a couple hundred times at least. But I mean, now that I've kind of had the benefit of time and I got forced into retirement, I can't play. In Vegas, it's a very fascinating place because it's kind of it's a mirage in a sense.
Mike is hedging his bets. Doesn't like this question.
Well, it does present I think a big part of its allure, besides it's become
dodge, weave. I'll let you get specific on it also, but how would you, in precise kinds of terms, almost in bullet form if you were going to do it, describe the psychology of the really good players? I know we talked a little bit about this before, but how would you describe the psychology of the really good players? What's one of the first characteristics you would look for? I mean, you had to go through a certain filtering mechanism. There's a lot of bright guys at MIT. Why were you chosen? What'd you do? What'd you have?
Well, to be perfectly honest, the reason I got recruited initially was just kind of dumb luck. It was a very good friend of mine happened to be on the team. He got recruited before I did, and he thought I would be a good fit. So actually, I wasn't screened by management of the team initially. It was a good friend that brought me in. But I think one of the reasons that I did well in blackjack, and I think this is the same for the other successful members of the team. The number one characteristic of successful card counters is discipline. And a big part of that is putting in the time and preparation before you sit down at a blackjack player so that you have the knowledge and the skill level so that you have the advantage. So you have to have discipline. You also have to have some mental endurance, because it's not all, like most professions, it's not all glamour. There's going to be times where it can be a bit of a grind, where there aren't any hot shoes, or especially if you have some losing streaks. So you have to have some intestinal fortitude. But I think playing on a team made that much easier, because it would have been, I think, a much different experience if I had tried to become a professional card counter solely on my own, where you have to weather those ups and downs by yourself, versus being part of a team where you have a bankroll and just the advantages of kind of camaraderie and sharing that common experience.
I asked some of the folks on my Facebook thing, I had not told them who I was talking with today, but I asked them if they had any questions. I mentioned MIT Blackjack team member, and if they had any questions. And we've talked through some of them that folks ask good questions. They want to talk about the Kelly criteria, stuff like that. One guy asked this one question. My first thought was originally it was kind of odd, and you could pass on it right away if you want. What did blackjack teach you about love? Is your reaction the same as mine?
About love?
Have you been asked that question before?
No, that's a first-time question for me. I mean, I guess, I don't know if it taught me anything about love per se. I guess a better word, the phrase, maybe, I don't know if he was going for this, so I guess passion. It definitely taught me a lot about passion, because blackjack's what I'm really passionate about. But love in the romantic sense.
Yeah, I wasn't sure, because I didn't want to discount it immediately. I wasn't sure if he was going more the passion side or the romantic side. And I was thinking the romantic side, well, maybe Mike could have been sitting next to somebody, but I wasn't sure where he was going. But, sitting next, he met his wife sitting next to the table. I don't know what he was going with that, the love side. But, well, speak to that for a second. Speak about passion. Because you are today, right now, you're an entrepreneur. You're an entrepreneur, and you were an entrepreneur, even though you were on a team. At some point in time when you broke away, you were running your own team. You've been an entrepreneur for a long time. So what is it about that aspect of it do you think correlates well with being a success in what you've done, the entrepreneurial aspect?
Well, what's interesting, back when up through high school, when I was clearly on the academic track and I got good grades and was doing well in school, I just had this, I knew that I wouldn't have a conventional job. I had no idea what my career path would be. So I think I just naturally, my personality is such as I like to, I know it's an overused term, think out of the box, do something a little bit off the beaten path. And that's why when this card counting opportunity came across, I just jumped all over it. For me, I knew that I was a natural fit. Whereas, for some people that we recruited, it was a little bit of a conflict with their belief system and what they're supposed to do, the quote unquote right thing. And maybe
they couldn't just view it as a game with the right rules. They had to bring in other biases.
Well, it was more so that, is this a legitimate... It wasn't so much of whether or not it was profitable, because they were smart enough to know that it was, but...
They didn't look into the legalities themselves?
Oh, not legitimate in the sense of legalities, because,
legitimate in respect by society.
Respect by society, especially we had a few team members, they didn't tell their parents about it, because they didn't know what they would think, or they thought their parents might.
Well, yes, if you spend your whole first 17 years getting the kinds of grades you get at MIT, the expectations are going to not necessarily be for your kid to come home and say, I'm counting cards. Is that?
Yeah, that was a big part of it, and for me, that was never even a thought, because one, I think I naturally was suited for this type of unorthodox opportunity. For me, it was clear cut. It's like, wow, this is cool. This is fun. I can apply math. I can do it in a very unique way. There's a whole art and deception side to it in a legal sense, as far as pulling the casinos. To me, it was a no-brainer. I also was fortunate in that my parents are very open-minded, and when I first told them about it...
Your dad was military.
Yeah, my dad was Army, so I was a military
Generally
brat.
don't think of that as being open-minded. You think of that as very rigid.
Yeah, that you would think that, but my parents were great. They always very open-minded, and that's not to say that when I first told them about it, they didn't have some concerns, because they, like me, they weren't gamblers at all. I'd never set foot in a casino, knew nothing about card counting. But when I explained it to them, and then later on, it just so happened that they went to Puerto Rico we're going into Puerto Rico on vacation at the same time I was in San Juan on a team trip, and I actually got them the casino to comp them the room, and they got to meet members of our team. They sensed right away that this was a serious business for us, that we weren't just out. It was the opposite. We weren't out drinking and gambling.
So they immediately saw it from the clever and ingenious side, and didn't look at it from some kind of negative perspective. They're like, oh wow, there's a hole in the system, and our son is working to exploit this hole in the system perfectly legally, perfectly rationally, and doing it well.
Exactly. I think the initial concern was they just didn't know anything about it, of card counting, like most people. But once they saw it for what it really is, they actually, beyond accepting it, they did have appreciation for kind of the cleverness, as you said, of it.
Well, let me ask you, so if you don't have a buddy who's on the MIT blackjack card counting team or one of the teams back in the day, what are you doing today? What would you, do you think you would have found some other entrepreneurial pursuit, or would you have gone to the steady Eddie corporate job that would have been expected of somebody with your academic chops?
You know, I've often wondered about that. I have no idea. It's funny how path in life works. You just never know where it's going to take you. I mean, I would like to think I would have done something kind of beyond the mainstream 9 to 5. Not that there's nothing wrong with that at all. Because if I had taken that route, I don't know if I could have stayed on that road and been happy, which I think happens to a lot of people, actually.
There's kind of a contradiction there. So the 9 to 5 route, there's nothing wrong with it, but I don't know if I could have stayed on it and been happy. Kind of cross currents there.
Oh, I mean, it's not.
You're not being critical of anybody.
It's not the thing for me. I see nothing, wrong with it. Different strokes for different folks.
Right.
Everyone's in a different place in life, different personality, situation, so forth. So, but yeah, when I say it's not right for me, but I would never take issue with anyone who's supporting themselves and their family.
Yeah, most people are in that situation. I think most people, I think that's why they'll enjoy the conversation like this, is I think people enjoy the possibility of breaking out, the possibility of not being working for the man. They enjoy that possibility. And so I think if people can learn, maybe, somebody, there's always a chance, no matter what your age, to try something different, to do something different. It might not be what I'm doing. It might not be what you're doing. But, this is ultimately a conversation of two entrepreneurs who kind of have taken the opportunities that were presented to us and have done something with it. And at the end of the day, it's all you can really do.
Yeah, and that is one of the most valuable lessons I've learned is, just taking chances. Obviously, you want to take smart, calculated risks, and you want to have a plan of action, but it's so easy, and I'm guilty of this myself in many respects, where you kind of just follow, it's easy to get brainwashed into what you're supposed to do, either through, expectations of family or society, but you'd be surprised by what you can accomplish, and just take a little bit of entrepreneurial courage, so to speak, and it can pay huge dividends. And even if you don't become a multi-millionaire, there's other huge benefits of being your own boss and doing what you really enjoy.
Yeah, absolutely. Let me ask, just for the folks out there that are because we've covered a lot of different territory. We've gone from psych to a little math, up and down, personal experiences. For the hardcore trader guys out there, the hardcore blackjack guys out there, clearly you can be reached, and the easy place to reach Mike is his website. So Mike Aponte, MikeApoente.com, easy to find. But where would you, if you were pointing to people, and I know we've talked about some of Ed Thorpe's work, but if you were pointing people to some good foundational discussions on Kelly, or some of the beyond even basic strategies, some of the math, where would you point them to? Now, obviously, Mike does work with clients, and I'm definitely saying to go check out his site. You might end up wanting to work with Mike, but where would you recommend, Mike, for people to dig in and get some basic information on this subject?
On blackjack
and Thorpe and gaming, and a lot of the things that are near and dear to you in your world. Where would you recommend? I know you've got a blog at your site, so they can jump in and grab a lot of stuff from there, a lot of insights there. And where else would you?
I think one really good site for information on not just blackjack, but all casino games is Wizard of Odds, spelled exactly like it sounds. It's run by a friend of mine, Michael Covel, and he has great information on there. If you kind of want to delve into the mathematics behind casino games as well. There are also, I mean, there's been a number of good books over the years. There's, Peter Griffin has some good books, Theory of Blackjack. So those
Beat the Dealer, the old classic.
Of course, Thorpe is, how could I forget what started it all, Beat the Dealer. But yeah, blackjack, it's interesting because if you're into the analytical side, you can kind of if you want, you can lose yourself in an academic sense on the back end, but you don't have to be a mathematician or understand standard deviation to apply it. It's like driving a car. You don't have to know how the transmission works and an electrical system to drive it. You just have to be a good driver, right? The same thing with card counting. It's people much smarter than me figured it all out and simplified it in a way that you can apply it and get the benefits. So.
I just remembered, and people are going to probably kick my butt for forgetting this, but in my film, I know you haven't had a chance to see it yet, but I interview a lot of poker players. As even more so, where we've talked about the connection between the quote turtle traders and some of them being part of blackjack teams, late 70s, early 80s. A lot of the top traders would bring up poker, and so some of the guys that I've interviewed in the film, some of the poker players in there, I'm sure you're going to be familiar with, Jesus and and there's a bunch of other guys in there. But let me talk to you about real quick as we kind of sum up. The house advantage in games of chance and where one should be playing. I mean, as far as I know, blackjack is it. If you can, otherwise, blackjack and poker. Where else do you have a chance to do well? And poker is not as obviously not as controlled a game as blackjack. So why don't you speak to that and just lay out once and for all from your perspective games of chance, odds, and where you have a shot. And for the people out there that want to say, oh no, I can do something with craps, or oh no, I can do something with roulette. I've got you here.
Yeah. Well, when it comes to casino games, they're broken down in two very important groups. One are games that are based on independent events, which are most casino games like craps and roulette. And so games that are based on independent events, there's no chance that you can win over the long run because the odds are permanently fixed in the house's edge. And for example, in roulette, it makes no difference where the ball has landed before. It gives you no insight as to where it will land next. It's a brand new ball game.
Now, Mike, explain to me. Mike has a little bit of mathematical expertise in this. He was very clear on his wording. So he said no chance.
Exactly.
Craps roulette, no chance in the long run.
I mean, what sucks gamblers in is that in the short term you have a chance. And so that creates the illusion that you can come out on top over the long run. But the longer you play, the more certain you can be that casino is going to end up with all of your money. It's the law of large numbers in effect. So, craps, baccarat, roulette, those are all independent-based games in which there's absolutely no skill because no matter what decision you make, whether you bet on pass, don't pass, black or red in roulette, the house always has the edge. Now, on the other hand, there are two games in which it is possible to win because they're based on dependent events, which means that as the cards come out, they give you real information about the cards that remain. And so these games, there's a huge skill component. And the two games where it's possible to win are blackjack and poker. Now, addressing poker first, poker is different from blackjack in the sense that you're actually not competing against the house. You are competing the house in that the house takes its rake. But when you win money, you're really beating the other players. So you have two opponents in a sense, the players and the house that takes its commission. So in poker, the house doesn't care who wins because they're just taking their commission. Now, poker, it's trickier. It's a different animal than blackjack in that you're competing against the most dangerous game, humans. which they're far less predictable, and there's just a lot of variables in there that are constantly changing. So you could take the 5 best poker players in the world, and they would all play a particular situation differently. There's not always a clear-cut black and white answer. So that makes it it makes it a tougher learning curve, but if you do become one of the elite players, it also makes the potential profits much greater. Blackjack, on the other hand, it's very systematic, black and white. So if someone to ask me between poker and blackjack, in which game can I, in the shortest time, gain an advantage and make money, it'd be blackjack. Because blackjack, you could learn at home, you could practice in a vacuum, and go to a casino and have an advantage. That's essentially what our team did. We would practice. We'd meet twice in a week in a MIT classroom and practice. We had our whole training system. People would practice on their own. And we made our training system such that once you passed, we knew that as soon as we set foot in the casino, we had the edge. So it's very black and white, because if you think about it, in blackjack, you're competing against the dealer who plays like an absolute robot. So that's something you can use to your advantage. If you know exactly how your opponent is going to play every time, well, if you take advantage of that through proper basic strategy, proper bet sizing, then that's what's going to enable you to come out ahead.
So in my film, I had a chance to interview a young guy named Paul Wasika, and Paul came in second in one of the World Series of Pokers. I think it was after this guy came in second to this guy Jamie out of LA. I can't remember his last name. And Paul, even at second, I can't remember. This is probably like the 07 or 06 World Series, and he won like 6 or 7 million coming in second. There's got to be a side of you where you say, man, why didn't blackjack get this sexiness to where I could pony up to these massive tournaments and, and come in second and pull in a quick 6 mil?
Yeah, I certainly have had those thoughts, but it all ties back to the fact that in blackjack you're competing against a house. So
it's not as sexy.
They aren't quite as... they don't get quite as excited about the best blackjack players as they do the best poker players. So.
That's interesting. Well, I think we're going to wrap up and grab a little more food here and close out, but appreciate Mike being on today, and maybe we'll get some additional conversations in the future. And appreciate it, Mike.
Yeah, appreciate it. Thank you for having me.
Absolutely.
It's been great.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.